The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Monetary Policy and the State of the Economy. I now recognize myself for 4 minutes to give an opening statement. Today, this committee convenes for a hearing on monetary policy and the state of the economy. Chairman Powell, welcome back. Today, I'd like to start by addressing the current elephant in the room when it comes to monetary policy and the Fed. This president has made it clear that he has no understanding or respect for the independence of the Federal Reserve. He has said the Fed, quote, doesn't have a clue, quote, unquote, and called it the most difficult problem for the U.S. According to media reports, he has discussed firing Chairman Powell, just as he has fired others he does not agree with. Let's be clear. It is essential that the Federal Reserve maintain its independence from the executive branch. And so, I urge Chairman Powell and other Federal Reserve Board governors not to submit to the high-pressure tactics of this president, who continues to push reckless and harmful economic and social policies. Another issue I hope Chairman Powell will address today is Facebook's recently announced plan, along with 27 other companies, to develop a cryptocurrency and digital wallet. I and other Democrats on the committee have raised concerns that Facebook's planned products may ultimately be intended to establish a parallel banking and monetary policy system to rival the dollar. In a letter last week, we asked Facebook to agree to a moratorium on any movement forward on its plans to create a cryptocurrency or digital wallet. I believe that Facebook is planning what they're planning raises serious privacy, trading, national security, and monetary policy concerns for consumers, investors, the U.S. economy, and the global economy. But Facebook's foray into this field should signal to all of us that our current system of regulation lacks adequate coordination, safeguards, and attention to cryptocurrency. Chairman Powell, the Fed should be a leader on this issue and should not take a wait-and-see approach when it comes to examining a financial system involving 2.4 billion people. So I look forward to hearing your views on Facebook's plans to create a cryptocurrency today. Another issue I would like to discuss is bank deregulation. I remain concerned about the Federal Reserve's actions to weaken safeguards that Congress and Chairman Powell's predecessors put in place following the financial crisis. Specifically, it appears that the Fed may be following the Trump administration's deregulatory plan to weaken the capital and liquidity buffers of some of the largest banks. As I've said before, I believe this to be ill-advised, particularly when many economists, including economists at the Federal Reserve, believe that current bank capital levels are on the low end of what would be necessary to withstand another financial crisis. I look forward to your testimony and to discussing these matters with you today. The chair now recognizes the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes for an opening statement.
Well, I thank the chairwoman for yielding. I'd like to, as well, welcome Chairman Powell back to the committee. Chairman Powell has prioritized outreach to Congress, and members of this body have benefited greatly from hearing his thoughts in February and in individual meetings since then. So we thank you for your return. I know the markets are interested in your testimony, but we as policymakers, too, are interested in your testimony. As I stated at our hearing in February, the economy over the last 2.5 years has witnessed remarkable growth, and unemployment has reached lows that many believe were impossible. Republican-led tax relief and regulatory reform have supported these trends, with millions of Americans benefiting from our policies. We're seeing this in wage growth. We're seeing this in continued job growth. All Americans are benefiting from this. These benefits continue to endure 5 months since your last testimony. And in the most recent FOMC statement, the Fed concluded that the labor markets remain strong and that economic activity is rising. Job gains have been solid and the unemployment rate remains low. But we cannot take our foot off the pedal. In February, we discussed how the Fed was undertaking targeted rulemaking to provide regulatory relief that allows financial institutions to operate efficiently in the communities that they serve and compete globally as well. I hope that you, Chairman Powell, will continue to work to undertake these efforts with a sense of urgency, especially in the rulemaking category. I also encourage Chairman Powell to maintain his commitment to transparency and proactive communication with Capitol Hill, especially when the Fed is considering changes to its policies and operations. At our last hearing, for instance, the chairman noted that the Fed continues to support its current inflation target. But as we know, there are numerous proposals that would affect how the Fed might pursue that target. I hope that the Fed will approach such proposals with an appropriate level of prudence, given the limitations of central banks' toolkits at this point in our economic cycle, until we fully understand how those limitations have emerged and how they can reliably be overcome. So finally, let me reiterate my concerns shared by the Fed itself, that global economic uncertainty could result in headwinds here at home. Prior to our February hearing, the Fed made clear that Europe and China represent the risks that the Fed would continue to monitor and, where appropriate, work to mitigate. I hope we can touch on those things today. Let me highlight China in particular. When the chairman last appeared before our committee, he noted that the Chinese economy is state-run, but that Beijing has also attempted to make certain market-oriented reforms. I'm concerned that these reforms may not be deep enough. When the world's second-largest economy is a one-party state without the rule of law, without transparent decision-making, where monetary policy and allocation of capital bends to politics and cronyism, where 1 million citizens can be locked up in camps, while another million take to the streets to defend their freedoms, then we all need to focus on that country and its regime as a unique source of risk to the global stability and global growth. So I would encourage the chairman to work with his colleagues, both here and abroad, so that we have a sufficient understanding of China, and as well as a sufficient set of tools within central banks if something were to go wrong. And again, thank you, Chairman Powell, for returning today. Thank you for your responsiveness. Your candor is welcome and encouraged. We thank you for attempting to speak like a normal human being, even amidst very complex financial markets and complex decision-making within our independent monetary policy group called the Federal Reserve. Thank you.
The chair now recognizes the subcommittee chair, Mr. Cleaver, for 1 minute.
Thank you, Madam Chair. We're pleased to have you here again, Mr. Chairman. Thank you for being here. And I wanted to discuss the impact of this trade war, over 500 days in this trade war. But I can't hardly move there because the number one concern I'm having is that this administration is very publicly trying to force financial markets and the Federal Reserve to lower interest rates to offset what I think to be an irrational trade war and poor fiscal policies. And the issue for me is that in January, I will have been on this committee for 15 years, and I have never seen a president meddle in the Federal Reserve as this president has, and it is deeply disturbing. And the problem is that it seems to be working because we're moving in the direction that he's been ordering, and hopefully you can address some of this when we get back into the question and answer period. Thank you, Madam Chair.
The chair now recognizes the subcommittee ranking member, Mr. Stivers, for 1 minute.
Thank you, Madam Chair. Chair Powell, welcome back to the committee. Because of the tax cut and regulatory reforms, the U.S. has seen unprecedented economic growth, wage growth, as well as record low unemployment and stable prices. And since the last time you were here, we've seen a mostly steady economy with unemployment at 3.7% and consumer prices only edging up about 0.1%. But I've heard anecdotal evidence of slowing investment and price increases. I want to thank you for your steady hand on monetary policy. That's an important part of our economic success. And while acknowledging the recent success, I know the FMOC meetings have pointed to uncertainties in economic outlook, meaning that your data may be telling you the same thing that I've been hearing. I do agree with Chair Waters that I want to hear about your perspective on Facebook's cryptocurrency. I think they are attempting to undermine the dollar as the world's currency. I also am interested in hearing your views of where we are in the business cycle and what we can do to support you on fiscal and other policies. I yield back the balance of my time.
Thank you very much. I want to welcome to the committee our distinguished witness, Jerome Powell, Chairman of the Board of Governors of the Federal Reserve System. He has served on the Board of Governors since 2012 and as its chair since 2017. Mr. Powell has testified before this committee, and I believe he does not need any further introduction. Without objection, your written statement will be made part of the record. Mr. Powell, you are now recognized to present your oral testimony.
Thank you and good morning. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to Congress. Let me start by saying that my colleagues and I strongly support the goals of maximum employment and price stability that Congress has set for us for monetary policy. We are committed to providing clear explanations about our policies and activities. Congress has given us an important degree of independence so that we can effectively pursue our statutory goals based on objective analysis and data. We appreciate that our independence brings with it an obligation for transparency so that you and the public can hold us accountable. Today, I will review the current economic situation and outlook before turning to monetary policy. I will also provide an update on our ongoing public review of our framework for setting monetary policy. The economy performed reasonably well over the first half of 2019, and the current expansion is now in its 11th year. However, inflation has been running below the FOMC's symmetric 2% objective, and cross-currents, such as trade tensions and concerns about global growth, have been weighing on economic activity and the outlook. The labor market remains healthy. Job gains averaged 172,000 per month from January through June. This number is lower than the average of 223,000 jobs per month last year, but above the pace needed to provide jobs for new workers entering the labor force. Consequently, the unemployment rate moved down from 3.9% in December to 3.7% in June, close to its lowest level in 50 years. Job openings remain plentiful, and employers are increasingly willing to hire workers with fewer skills and train them. As a result, the benefits of a strong job market have been more widely shared in recent years. Indeed, wage gains have been higher for lower-skilled workers. That said, individuals in some demographic groups and in certain parts of the country continue to face challenges. For example, unemployment rates for African Americans and Hispanics remain well above the rates for whites and Asians. Likewise, the share of the population with a job is higher in urban areas than in rural communities, and this gap has widened over the past decade. A box in the July Monetary Policy Report provides a comparison of employment and wage gains over the current expansion for individuals with different levels of education. GDP increased at an annual rate of 3.1% in the first quarter of 2019, similar to last year's pace. This strong reading was driven largely by net exports and inventories, components that are not generally reliable indicators of ongoing momentum. The more reliable drivers of growth in the economy are consumer spending and business investment. While growth in consumer spending was weak in the first quarter, incoming data show that it has bounced back and is now running at a solid pace. However, growth in business investment seems to have slowed notably, and overall growth in the second quarter appears to have moderated. The slowdown in business fixed investment may reflect concerns about trade tensions and slower growth in the global economy. In addition, housing investment and manufacturing output declined in the first quarter and appear to have decreased again in the second quarter. After running close to our 2% objective over much of last year, overall consumer price inflation, measured by the 12-month change in the price index for personal consumption expenditures, or PCE inflation, declined earlier this year and stood at 1.5% in May. The 12-month change in core PCE inflation, which excludes food and energy prices and tends to be a better indicator of future inflation, has also come down this year and was 1.6% in May. Our baseline outlook is for economic growth to remain solid, labor markets to stay strong, and inflation to move back up over time to the committee's 2% objective. However, uncertainties about the outlook have increased in recent months. In particular, economic momentum appears to have slowed in some major foreign economies, and that weakness could affect the U.S. economy. Moreover, a number of government policy issues have yet to be resolved, including trade developments, the federal debt ceiling, and Brexit. And there is a risk that weak inflation will be even more persistent than we currently anticipate. We're carefully monitoring these developments and will continue to assess their implications for the U.S. economic outlook and inflation. The nation also continues to confront important longer-run challenges. Labor force participation by those in their prime working years is now lower in the United States than in most other nations with comparable economies. As I mentioned, there are troubling labor market disparities across demographic groups and different parts of the country. The relative stagnation of middle and lower incomes and low levels of upward mobility for lower income families are also ongoing concerns. In addition, finding ways to boost productivity growth, which leads to rising wages and living standards over the longer term, should remain a high national priority. And I remain concerned about the longer-term effects of high and rising federal debt, which can restrain private investment and in turn reduce productivity and overall economic growth. The longer-run vitality of the U.S. economy would benefit from efforts to address these issues. Against this backdrop, the FOMC maintained the target range for the federal funds rate at 2.25% to 2.5% in the first half of this year. At our January, March, and May meetings, we stated that we would be patient as we determined what future adjustments to the federal funds rate might be appropriate to support our goals of maximum employment and price stability. At the time of our May meeting, we were mindful of the ongoing cross-currents from global growth and trade, but there was tentative evidence that these cross-currents were moderating. The latest data from China and Europe were encouraging, and there were reports of progress in trade negotiations with China. Our continued patient stance seemed appropriate, and the committee saw no strong case for adjusting our policy rate. Since our May meeting, however, these cross-currents have reemerged, creating greater uncertainty. Apparent progress on trade turned to greater uncertainty, and our Contacts in Business and Agriculture report heightened concerns over trade developments. Growth indicators from around the world have disappointed on net, raising concerns that weakness in the global economy will continue to affect the U.S. economy. These concerns may have contributed to the drop in business confidence in some recent surveys and may have started to show through to incoming data. At our June meeting, we indicated that, in light of increased uncertainties about the economic outlook and muted inflation pressures, we would closely monitor the implications of incoming information for the economic outlook and would act as appropriate to sustain the expansion. Many FOMC participants saw that the case for a somewhat more accommodative monetary policy stance had strengthened. Since then, based on incoming data and other developments, it appears that uncertainties around trade tensions and concerns about the strength of the global economy continue to weigh on the U.S. economic outlook. Inflation pressures remain muted. The FOMC has made a number of important decisions this year about our framework for implementing monetary policy and our plans for completing the reduction of the Fed's securities holdings. At our January meeting, we decided to continue to implement monetary policy using our current policy regime with ample reserves and emphasize that we are prepared to adjust any of the details for completing balance sheet normalization in light of economic and financial developments. At our March meeting, we communicated our intention to slow, starting in May, the decline in the Fed's aggregate securities holdings and to end the reduction in these holdings in September. The July Monetary Policy Report provides details on these decisions. The report also includes an update on monetary policy rules. The FOMC routinely looks at monetary policy rules that recommend a level for the federal funds rate based on inflation and unemployment rates. I continue to find these rules helpful, although using these rules requires careful judgment. We are conducting a public review of our monetary policy strategy, tools, and communications, the first review of its kind for the FOMC. Our motivation is to consider ways to improve the committee's current policy framework and to best position the Fed to achieve maximum employment and price stability. The review has started with outreach to and consultation with a broad range of people and groups through a series of Fed Listens events. The FOMC will consider questions related to the review at upcoming meetings, and we will publicly report the outcome of our discussions. Thank you, and I'll be happy to respond to your questions.
Thank you very much, Chairman Powell. I now recognize myself for 5 minutes for questions. On June 18th, Facebook announced its plans to launch Libra, a new global cryptocurrency, as well as a new payment system, Calibra, which will facilitate Libra transactions. On June 24th, the Federal Reserve's Vice Chairman of Supervision, Randall Quarles, quote, a letter in his capacity as chairman of the Financial Stability Board to the G20 leaders, noting a wider use of new types of cryptocurrency, crypto assets for retail payment purposes would warrant close scrutiny by authorities to ensure that they are subject to high standards of regulation, end quote. Signaling that global regulatory coordination of Facebook will be a priority. Chairman Powell, did the Federal Reserve speak with Facebook about their Libra currency, and if so, were any concerns raised? Does the Federal Reserve have any authority to supervise and regulate what could be the world's largest payment system? Does the Federal Reserve have any concerns about monetary policy with regard to Libra?
Thank you, Madam Chair. We did actually have a meeting with representatives of Facebook a couple of months before the announcement. I think they made fairly broad set of visits to authorities around the world. But getting to your questions, let me start by saying that we do support responsible innovation in the financial services industry as long as the associated risks are appropriately identified and managed. And as we'll discuss, while the project's sponsors hold out the possibility of public benefits, including improved financial access for consumers, Libra raises many serious concerns regarding privacy, money laundering, consumer protection, and financial stability. These are concerns that should be thoroughly and publicly addressed before proceeding. And that's why at the Fed we've set up a working group to focus on this set of issues. We are coordinating with our colleagues in the government in the United States, the regulatory agencies and Treasury. We're coordinating with central banks and governments around the world to look into this. And I'll just add that the process of addressing these concerns, we think, should be a patient and careful one and not a sprint to implementation.
So are you speaking of a working group within FSOC?
Well, the Fed has we have our own working group. I believe FSOC has already got a working group at the staff level, or in effect has a working group at the staff level. So,
Well,
yes.
FSOC does have a cryptocurrency working group. Is FSOC or this working group reviewing the extensive policy questions and potential impact that Libra and Calibra have? Do you know what they're doing?
I do believe they are. I know there was a staff level meeting just last week to focus on Libra at FSOC, so all the agencies were there. So I think the answer to your question would be yes.
Do you think that FSOC will designate, or is FSOC considering designating the Libra Association and Calibra either as systemic financial market utilities or non-bank financial companies and subject them to enhanced regulatory oversight? Are you aware of that?
I think it's early to say. There hasn't been a principals meeting of FSOC since the Libra announcement. And while there have been conversations, I think it's highly likely that FSOC will be taking this on in a serious way, but that is in the hands of the Treasury Secretary who chairs FSOC.
Thank you very much. Mr. Chairman, if you got a call from the President today or tomorrow, and he said, I'm firing you, pack up, it's time to go, what would you do?
Well, of course, I would not do that.
I can't hear you.
My answer would be no.
And you would not pack up and you would not leave?
No, ma'am.
Because you think the President doesn't have the authority? Is that why you would not leave?
I've kind of said what I've intended to say on the subject, and what I've said is that the law clearly gives me a 4-year term, and I fully intend to serve it.
Okay, so I hope everybody heard that. With that, I will yield to the gentleman from North Carolina, the ranking member, Mr. McHenry.
So, Chairman Powell, in your testimony, you said you'll use macroeconomic data to inform your decision on whether lower interest rates are required at the end of the month or not. What specific data would likely lead to you recommending a change in rates?
Between now and the end of the month, there's data coming in on almost everything. You'll have labor market data, you'll have second quarter GDP, you'll have retail sales, you'll have a broad range of data coming over the next 3 weeks, and we'll be looking at all of that. I wouldn't point to any one data point or even any period. We try to look over longer periods of time and assess what's really going on a more fundamental level, and that's what we'll do as we evaluate the incoming data.
And there is also an understanding of the market assumption of what the Federal Reserve Open Markets Committee will do as well. Is there not?
There is. We look at a broad range of financial conditions. We don't focus on any one thing, but our policy works through financial conditions, and so we'll look at a broad range of things in the financial markets.
So a broad range of things, macroeconomic data. Emotion?
Emotion? Not on our part. We'll try to be very rational and analytical and transparent about how we're thinking about these things.
So along the lines of transparency, the velocity of the economy you speak to, and the larger global macroeconomic issues that are at play here as well. So along those lines, is the Federal Reserve, does the Federal Reserve have the capacity to make independent monetary policy decisions under law?
Yes, we do.
Is that impeded by people saying negative things about you?
We will.
Is that
always,
enhanced or diminished based off people saying positive or negative things about you?
Neither. We will always focus on doing the job you have assigned us, and we will always do it to the best of our ability and based on objective analysis and facts.
So along those lines, we have a significant change to LIBOR policy. And I wrote to Vice Chair Quarles along those lines. The Fed has spoken publicly about this as well, that there's been a major progress made in terms of the swaps and derivatives contracts. I remain concerned about legacy retail contracts as well. Has the Fed undertaken analysis along those lines about legacy retail contracts and the use of LIBOR?
Yes, indeed we have. And that's a very important part of the project going forward. So we've reached out to representatives of retail users of LIBOR for some time now and are meeting with them regularly and developing plans to deal with that because, as you know, as you pointed out in your letter, a significant quantity of the LIBOR contracts are, in fact, mortgages and the like. So that's a really important area. We did the derivative things first because they were close to hand and quite large, but we're working hard on the retail side now.
So is there any estimate on the number of loans that would have to be renegotiated because of this policy change?
I can't have a number for you. I mean,
okay. So I also want to touch on Project Libra. You mentioned and answered a number of those questions. It looked like you're quite prepared for that. You mentioned financial stability as a concern. Why? Why is Project Libra a question of financial stability in your view?
well, really due to the possibility of quite broad adoption. Facebook has a couple billion plus users, so you have, I think, for the first time, the possibility of a very broad adoption. And if there were problems there associated with money laundering, terrorist financing, any of the things that we're all focused on, including the company, they would immediately, they would arise to systemically important levels just because of the mere size of the Facebook network. And the company has said so explicitly.
Is it a problem that we don't have a regulatory regime that's permissive of these technologies to be developed here in the United States?
I don't know that that's a problem. That's a question of Whether we're impeding blockchain, I don't believe so, but I don't know the answer to that.
But there's an opportunity here for financial inclusion benefits and innovation benefits if this worked well, is there not?
There is that possibility, and as I mentioned, that is the main benefit the company is holding out. And I also mentioned that we are open to financial innovation. We just want it to take place in a safe and sound way.
Thank you.
The gentlewoman from New York, Ms. Maloney, is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member, and thank you for your service, Chairman. Chairman, in June, the Fed decided not to cut interest rates and to take a wait-and-see approach instead. In your press conference, you said this approach was justified because, and I quote, "We will see a lot more on all of these issues in the very near term," end quote. Last week, we got the job numbers for June, and they were very strong, with the employers adding 224,000 jobs. So my question is, did the June jobs report change your outlook for whether a reduction in interest rates is appropriate in the near term?
Well, a straight answer to your question is no, but I will give you the context. We look at a broad range of data. So let's start abroad, where I think since the June meeting and for a period before that, the data have continued to disappoint. And that's very broad across Europe and around Asia, and that continues to weigh. And by the way, manufacturing, trade, and investment are weak all around the world. We have a box that talks about that in the monetary policy report. In the United States, we did get a job report that was positive, and that's great news. And we had some other reasonably good news. I would say the U.S. data came in about as expected. And I would also say that let's go to trade. We've agreed to begin discussions again with China, and while that's a constructive step, it doesn't remove the uncertainty that we see as overall weighing on the outlook. So I would say that the bottom line for me is that the uncertainties around global growth and trade continue to weigh on the outlook. In addition, inflation continues to be muted, and those things are still in place.
Okay, Mr. Chairman, some economists and many market participants believe that the Fed should cut interest rates by a full 50 basis points in July, rather than a normal cut of 25 basis points. Personally, I don't see the case for cutting rates by 50 basis points because the economy is quite strong right now. What economic factors do you believe would justify taking the unusual step of cutting rates by a full 50 basis points?
At our meeting, which is in 3 weeks, we'll be looking at a full range of data. And I would just take you through the story I just told you. That'll be what we're thinking about, is the extent to which trade developments and concerns over global growth are weighing on the outlook, and also the performance of inflation. Those are the factors that we've identified, and all of that will go into our decision-making.
And also, Mr. Chairman, you have repeatedly stressed that uncertainty about trade policy is a major economic headwind and is one of the factors that could lead the Fed to cut rates this month. But as we've seen under the President's, very unlikely that we'll ever get much certainty on trade policy. It keeps changing every day. So my question is, what kind of progress in trade negotiations do you need to see in order to put your mind at ease about trade developments not being a headwind, to use your term, to economic growth?
I guess I ought to start by saying that no one should interpret what I'm saying about trade headwinds as in any way a criticism of trade policy. We do not play a role in assessing or criticizing or trade policy. It's not something that's assigned to us. We react to anything that, in principle, anything that can affect our ability to achieve the dual mandate goals you've assigned us is something that could, in principle, call for a policy response. Right now, that is global headwind, global weakness, and trade developments are things that are widely thought to have that effect. That's all. So I wouldn't want to try to prescribe a specific answer, and again, it wouldn't be ours to do in the first place.
Well, hopefully we'll have some answers on trade soon, and thank you for your service, and I yield back.
The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you, Chairman Powell, for being here today to testify. Chairman Powell, Vice Chairman Quarles just yesterday indicated the Federal Reserve would revise its stress capital buffer proposal in the near future. Vice Chairman Quarles indicated one option would be to look at an average of stress test results over a number of years. Are you in agreement with Vice Chairman Quarles that this is something that needs to be considered, and what factors might necessitate this change, sir?
So we are in the process of evaluating, I think in the late stages of evaluating how to put into effect the stress capital buffer, which merges the results of the stress tests with the underlying overall capital framework. It's a complicated exercise. There are many moving pieces. That's one of them. I wouldn't want to single any single one out as important for our consideration, but that's
So
one of
the
the
average, taking an average of stress test results over a number of years is something that's under consideration, but is maybe a change that you're not necessitating just yet, or?
We're very much in the process of evaluating all of those ideas, and I wouldn't want to single that one out as either in or out. Just there are many pieces, but yes, that is one of the pieces.
Mr. Chairman, you said
being
you're in the
looked at.
late stages. What's your time frame, do you believe, for coming up with an option in terms of the stress capital buffer proposal?
I'd have to come back to you with a date, but it would be within soon, in the near future.
Thank you. Chairman Powell, at your January press conference, you were asked whether a $4 trillion balance sheet gave you sufficient firepower to handle a future recession, and you answered yes. However, the Fed's balance sheet as a share of GDP is about where the Bank of Japan balance sheet was prior to the financial crisis. Today, the Bank of Japan has ended up with a balance sheet as large as the Japanese economy, with mixed results on inflation and limited room to handle another downturn. Has Japan's experience, sir, affected your thinking on the appropriate size of the Fed's balance sheet?
I think there are a lot of lessons to be learned from the experience of Japan really over the last quarter century, and all of us have looked very careful at that.
And to that point, if I may, why should we feel certain that the U.S. could avoid a similar fate? And perhaps you could elaborate.
What Japan has found itself in a situation where inflation has gotten down close to zero for a very long time, and they've tried many, many things, including, as you mentioned, extensive asset purchases and all sorts of forward guidance to move inflation back up, and have not met with much success, although they continue to struggle to do that. So my main takeaway from that, and by the way, the European Central Bank is fighting that battle as well. My main takeaway from that, honestly, is that the Fed needs to stand here and try to keep inflation symmetrically at 2%. We don't want to get on that road of declining it. To the extent inflation continues to decline and expectations decline, that will show up in lower interest rates, which will give the central bank even less firepower to react. And we see that road is hard to get off of. So I think it's quite important that we fight at 2% to keep inflation up to 2% and use our tools to achieve that symmetrically, and we're strongly committed to doing that.
The most recent monetary policy report stated, and I quote, "Consumer spending in the first quarter was lackluster but appears to have picked up." And you talked a little bit about this in your opening statement, Mr. Chairman. Can you please explain the possible variables behind lackluster consumer spending and why the recent turnaround?
Well, I think the consumer part of the economy is 70% of the economy, and it's healthy, it's strong, it's good job creation, it's rising wages. Workers' surveys show that they think jobs are plentiful. Business surveys show that they think workers are scarce. So this is a good place for the consumer part of the economy, and you see that in surveys, you see it in consumer spending and things like
The
that.
concerns about workforce development and having enough able workforce is very key. You're right.
They are, but I think a tight labor force is lifting all sorts of communities into the labor force, and it's good. The issue really is more now on the business side, where we see business confidence and business investment weakening a bit.
I thank you. I've run out of time. I yield back to the chair. Thank you, sir.
Mr. Clay, the gentleman from Missouri is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for your visit today. In its blog published just yesterday, the St. Louis Federal Reserve noted that a rise in uncertainty is widely believed to have detrimental effects on macroeconomic, microeconomic, and financial market outcomes and induce responses from monetary, fiscal, and regulatory policymakers, they wrote. Theoretical models suggest that rising uncertainty can affect economic activity and decision-making in various ways. The authors explained, in particular, they noted firms may delay investment and hiring, households may reduce spending by increasing their savings rates if they anticipate possible changes in their income or wealth. Financing costs may rise if risk premiums increase, and even in your own testimony submitted to this committee, you noted that consumer spending has bounced back from a sluggish first quarter and is chugging along. And this uncertainty is exacerbated for consumers in Missouri when the president is gloating about how great the economy is, yet the Federal Reserve is considering a rate cut. How do you account for these mixed messages?
Well, I haven't seen that blog post, but I would strongly agree with the sense of it. We do think that uncertainty can cause businesses to hold back on investment and hiring. In fact, we've been hearing that in our FOMC-based discussions with businesses around the country. Household confidence has remained high, but over time, uncertainty can cause households to hold back as well. So I think that's a pretty standard finding.
What about the factor of savings? I mean, how does that play into?
Savings?
Yeah. Is that good or bad?
Sorry?
Is that good or bad for families to save?
Well, the savings rate has actually been fairly high lately, and that is a good, well, it's good for people to save what they think they need to save. And I think as a general thought, as a general fact, Americans need to save more for retirement than they have. They're not oversaving, they're undersaving in the aggregate. So it's a good thing.
Could they also be saving in anticipation of a calamity, of an economic calamity occurring?
Well, yes. I was going to say that there's also it's good to save, but at the same time, if there's a shock to confidence, you can see people pulling back from their regular consumption patterns, and that will show up in demand, and the economy will weaken.
Okay, as far as the decision-making on the part of the Fed, are you relying on conventional economic data or being swayed by jawboning of the president?
We see the economy as being in a good place, and we're committed to using our tools to keep it there. As we've discussed, the overall economy is performing reasonably well, but we see what we've called cross currents, principally trade developments and concerns over global growth. And we see those, and many FOMC participants at the last meeting saw those as weighing on the outlook and calling for possibly more accommodative policy.
Thank you for that response. And Chairman Powell, despite data proving that diverse companies perform more successfully, we still find that financial services industry is largely white and male at its highest level. What more can you do as chair to incentivize diversity and equity within the Federal Reserve System?
Thank you for that question. We put a very high value on diversity. I strongly believe that having diverse perspectives around the table leads you to better decisions. And I believe in having a culture where people are free to speak and will be heard. And that goes to all different dimensions of diversity. So we've made, I think, a lot of progress at the Fed. I think I would never say there isn't more to do. There's a lot more we can do. And I think we're very focused on that as an organization. I would say most of my career was in the private sector. I saw that really successful companies, one of the things they do well is they do diversity well, because that's how you get better results with diverse perspectives. So we're strongly committed to that.
Thank you, and my time's up. You're back.
Mr. Stivers, the gentleman from Ohio, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, I really appreciate you being here. I want to thank you for your transparency and accessibility as Fed Chair, and you've been available to all of us in our offices, in your office, and I appreciate that. This committee hearing is about monetary policy and the state of the economy, and I'll stay focused on those issues and leave the regulatory issues to when Vice Chair Quarles is here. And with regard to monetary policy, when I was in your office, I really appreciate you keeping the 100 million Venezuelan bolivars I gave you as you answered to your question, to the question on Japan. Once inflation starts rolling, it's really hard to get a control of, as the Venezuelans have found. And so the fact that you guys have a stable price target and are sticking to it, I think makes a huge difference. I know that there's a lot of potential shocks, including tariffs and other things that can impact that, but so far you guys have done a great job on monetary policy. And in your question, or in another question about unemployment, and the tight labor markets, I think you talked about the fact that wages are starting to go up. It's starting to actually benefit people who've actually not benefited from this economic expansion over the last 10 years, which is a good thing. And I know some observers have been calling for a so-called hot monetary policy on the premise that further tightening of the labor market will benefit those demographics that have missed out on the expansion and drive up wages and make labor markets tight and help those folks. Can you comment on whether the members of the FMOC have talked about those views and what the potential risks and benefits associated with a hot monetary policy might be?
You know, I guess I would start by saying that we don't have any basis, pardon me, or any evidence for calling this a hot labor market. Pardon me. We have wages moving up at a little above 3%, and that's good. It's good because it was more like 2% 5 years ago. But 3% barely covers productivity. It doesn't even really cover productivity increases and inflation. And it certainly isn't a high enough wage to put any upward pressure on inflation. And we haven't seen, as this long cycle has gone on, we haven't seen wages moving up as sharply as they have in the past. I do think it's very gratifying that for the last 2 years, the greater part of wage gains have gone to people at the lower end of the wage spectrum and education spectrum. That's a very positive thing. But 3.7% is a low unemployment rate, but to call something hot, you need to see some heat. And while we hear lots of reports of labor, of companies having a hard time finding qualified labor, nonetheless, we don't see wages really responding. So I don't really see that as a current issue.
Great. And, if we want to see wages continue to grow, we're going to need economic growth. And one of the things that this Congress has in front of it is the USMCA. I know a lot of the questions you're going to get are going to be about trade war with China, but can you comment about the importance of the USMCA and the North American investment that a lot of companies have made in a North American supply chain?
Pardon me, I wouldn't take a position on the details of the USMCA, though, but I will say that having it pass would remove a real bit of the uncertainty that is weighing on the outlook, and I think it would be quite a positive thing from that standpoint.
And I think that's what we all need to focus on is fighting the uncertainty, and there are things we can do with that. And I think as policymakers, we need to come together and do that. The last question, because I've only got a minute left, is on Libra and Facebook. If Facebook can't sufficiently answer your questions about anti-money laundering, know your customer, what would your message be to the banks that provide banking to Facebook, and what would your advice to Facebook be?
Well, I don't think that the project can go forward, and I just think it cannot go forward without there being broad satisfaction with the way the company has addressed money laundering, all of those things. There are a number of concerns that I listed at the beginning: data protection, consumer privacy, all of those things will need to be addressed very thoroughly and carefully, and again, in a deliberate process that will not be a sprint to implementation.
And I want to echo your comments that we all want innovation, but we want innovation that protects data security and the know your customer, anti-money laundering laws that are so important to our economy. Thank you. I yield back the balance of my time.
Mr. Scott, the gentleman from Georgia, is now recognized for 5 minutes.
Thank you very much. Welcome, Chairman Powell. Good to see you again. First thing I want to say to you is I want you to stay strong, be courageous. It is important for this nation and the economy of the world that the Federal Reserve, remain strongly independent. The other thing I want to say to you is have no fear. The president can't fire you. And we in Congress, both Democrats and Republicans, got your back. Now, I want to go to what I think is, and it's been mentioned a couple of times, this Libra business is really disturbing, and it's a serious problem. And let me tell you why. First of all, I think we all know Libra is the London Interbank Offered Rate. Very critical. It has and is the standard for the base rate for hundreds of trillions of dollars, both overnight and term loans, debt, derivatives, and it is the standard that has been used internationally and extensively in the United States, affecting individuals, small businesses, large corporations. So we got a big issue here. But because of pervasive manipulation now, it is apparent that Libra is going to leave us or be removed within the next year or so. So this creates a big problem. And so I want to ask you, because the most critical part of this is that parties to both sides of the financial contracts should be and must be concerned in the short term about the potential ramifications of the end of Libra, specifically in contracts that do not have a fallback position. And as you know, without a fallback language or some appropriately established safe harbor until a new reference rate can be used, significant legal problems and challenges are likely to occur. So, with this in mind, as Libra's schedule end nears, and so far is the secured overnight financing rate apparently will take its place. Tell us, Chairman, what can we do? What can be done to accommodate the numerous contacts that do not have fallback positions?
Thank you, Mr. Scott. I think you said it very well. This is I think there are 300 trillion plus in contracts referencing LIBOR in 5 different currencies. And the manipulation was revealed really almost a decade ago, and I think the Financial Conduct Authority, which supervises the LIBOR banks, has said it will not compel the banks to submit LIBOR past the end of 2021, and LIBOR could then end. So we've spent many years now looking at ways to make sure that contracts do have fallbacks, and we're working with, we've worked with the retail groups in particular now for mortgages and things like that to find a way so that if LIBOR is not published, there will be a rate that is the fallback rate, and that has to be put into contracts in one way or another. It's a vast project. It's one that many people are working on and working hard to meet that deadline.
Yeah, and LIBOR will be gone. Am I right? Am my calculations right? Within the next year or so?
It's actually, I think, the end of 21. It won't necessarily be gone, but the banks will no longer be required to submit their estimates of the of their interbank borrowing rates, and so it may go away. And I think we're requiring people to assume that it will, so that they'll be ready if it does.
Yeah, when you say ready for the dust, what are you
Ready if it does go away.
Oh, if it does go away.
Yes.
So if it does go away, what will the situation be like?
Well, ideally, this is the situation we're aiming for, is one in which people have either moved their obligations to SOFR, as you mentioned, secured overnight funding rate, or some other rate, or failing that, they have a rate in their contract where if LIBOR is no longer published, the other rate just seamlessly falls into place, and the two parties to the contract, the consumer and the bank, let's say, they know what the rate is, and they know that, so that's what we need to accomplish. And again, we're working hard on it.
Yeah, thank you, Chairman.
Thank you.
Mr. Kustoff, the gentleman from Tennessee, is now recognized for 5 minutes.
Thank you, Madam Chairman, and thank you for convening today's hearing, and thank you, Mr. Chairman, for appearing today. If I could, I'd like to follow up on a line of questioning that Congressman Stivers had relating to the USMCA. If you could you, we're going to face the option of passing it or not passing it in this Congress. What is the effect to our economy if we do, in fact, pass the USMCA? And conversely, what is the effect to the economy if we fail to pass the USMCA?
I don't actually have a precise evaluation for you of what the effects of passage would be. Overall, it's pretty similar to NAFTA. So I would imagine that the longer-term differences, the differences will show up over the longer term. I think the effects of not passing it would really depend on what happens to NAFTA. If NAFTA were then to be terminated, there could be quite a lot of uncertainty. And I think there is some uncertainty now about what's going to happen. I think the passage of it would remove that uncertainty, and that would be a good thing.
And would also be positive for our farmers and our ag communities if USMCA were passed.
Yes, I think it would.
Do you have an opinion how the passage or the non-passage of the USMCA affects our leverage with China in negotiations and trade negotiations?
I don't think it would be appropriate for me to comment on those negotiations, and I don't really have an answer for you on that.
In the next several weeks, purportedly, we're going to be voting on a proposal to raise the minimum wage to $15 an hour. There was a CBO report that came out in the last day or so that estimated that a raise in the minimum wage to $15 an hour should cut 1.3 million jobs up to 3.7 million jobs. What would the effect be to the economy if Congress were to pass a minimum wage bill of raising the minimum wage to $15 an hour?
The question of the minimum wage is really one for you. I think there are a range of studies that have different outcomes, but like the CBO study, what they tend to show is that a number of people get higher wages, and a number of people lose their jobs. And those numbers will change depending on what assumptions you make. And it really is something that there is no consensus among economists. Economists are all over the place on this. So it's really a question for you to sort of look at. I would look at a range of studies and not take any single one, and I would weigh that and say, are the benefits worth the likely costs?
What is the effect to the economy if 1.3 million people lose their jobs or 3.7 million people lose their jobs as a result of the rise in minimum wage to $15 an hour?
Well, it would, it would depend on, again, there would be costs and benefits. We know that some people would get higher wages, and they would, presumably, they'd be better off and they'd spend more. So it's not a judgment that we make. On net, it's a judgment that you have to make, that there'll be people who are made better off by it, and those are all the people who have the higher minimum wage, but there will be a number of people who lose their jobs because that's what will happen, I think, empirically.
Would the Federal Reserve be concerned if 1.3 million people to 3.7 million people lost their jobs because minimum wage was raised to $15 an hour?
Again, Mr. Kustoff, we do not take a position, we never have taken a position on the minimum wage, and we would take whatever decision you make as the decision that we would put into our models, and we would just take it as a given. We wouldn't express either support or disapproval.
When I'm back home in West Tennessee, what I hear generally from employers, small, medium, and large, the economy's good, we're making money, we're making more money than we made in 20 or 30 years. We can't find enough employees, we can't find employees with soft skills, we can't find employees who have the skills we need for the jobs, we can't find employees who can pass a drug test. Specifically, and you've talked about this publicly, the effect of the opioid crisis on the workforce. What is your feeling with that, and how does the opioid crisis affect the workforce?
An extraordinary number of people are taking opioids in one form or another, and it weighs on labor force participation, largely but not exclusively on younger males, also younger women. And it's a national crisis, really. And I mean, there's the humanitarian aspect of it is completely compelling, but the economic impact is also quite substantial.
Thank you, Mr. Chairman.
Thank you.
The gentleman from Colorado, Mr. Perlmutter, is now recognized for 5 minutes.
Chairman, good to see you. Thanks for your testimony today. Let me just start with some questions that Mr. Scott was asking on Libra. Given sort of the uncertainties and the ability to kind of manage this new currency, if you will, I mean, would the Federal Reserve, would you support some postponement in their implementing Libra, or any kind of a moratorium until we got to have a better understanding of the impact really on our economy and our ability to manage money?
I think that there are deep, important, serious questions across a range of issues here that will need to be addressed, and the process of doing that is going to have to be patient and thorough and not a sprint, and that's what I would say. So I do think there's a lot of work going on at the Fed and at other agencies, and I think in the government to understand these issues. I think it's something that doesn't fit neatly or easily within our regulatory scheme. It does have potentially systemic scale, and for all the reasons we've discussed, it needs a careful look. And so I strongly believe we need to all be taking our time here.
I'm going to take that as a yes. Thank you. Now I got a couple other questions, and I don't know if you have your booklet in front of you, but I always like the graphs that you folks prepare because they're very informative, and especially graph 2 in my district in Colorado. So graph 2 is really the unemployment rate, and the fact that for about 9-10 years now, there's been a steady decrease in unemployment. In my district in Colorado, we've enjoyed under 3% for about 7 years running, which is pretty remarkable. So I want to thank you, and I want to thank the Federal Reserve for the role you've been playing there. But one of your answers really, I think, is important to what we face as members of Congress, is the fact that for most Americans, their wages still, they're struggling, month to month, year to year, to get ahead, to really be able to deal with the costs that we all see. So in your predictions, in what the Federal Reserve's doing, do you see improvement in what everyday Americans are making and sort of catching up and getting ahead where they lost a ton through the recession and the years right after that?
So what we're hearing, we're hearing this quite a lot from people who work and live in low and moderate income communities, is that there really hasn't been a recovery for these people until recently. But now they are feeling, with this tight labor market, they are feeling employers who are waiving, issues that might have prevented people from being in the workforce. They're willing to look past those. They're recruiting people who have been outside the labor force. In fact, we've had people say to us that this is really the best field that they've had for many years, if ever. And all of that really, in my thinking and our thinking, just says how important it is for us to continue to sustain this expansion. This has really come together just in the last, we've had a long, as you can see from that chart, the labor market has improved steadily for 10 years now, but just in the last couple of years, it started to reach communities at the edge of the workforce, and it's just so important for us to continue that process for a couple of years, and that's why we're so committed to using our tools to sustain the expansion.
Thank you. My last question, the only graph that I saw that really is kind of perplexing and problematic is on page 31 of your of the monetary policy report, and that's the one on trade policy uncertainty. And if there's a place that I think we as members of Congress are concerned, and I think both Democrats and Republicans, it is on trade policy. And this graph, if I read it correctly, shows that it isn't just members of Congress that are concerned about the president's trade policy, it's the people that you survey. I mean, can you tell me what that graph says?
Well, it shows trade policy as quite elevated, and I think we know that. In our beige book, we report discussions from around the country, from all kinds of business and community folks, and I think trade policy has been elevated, and it's been particularly elevated since May, by the way. It's spiked in May with those developments, and there's no question it's elevated.
All right. Thank you for your testimony, sir.
Thank you.
Mr. Hollingsworth, the gentleman from Indiana, is now recognized for 5 minutes.
Good afternoon. I really appreciate you being here. Good morning, rather. I can tell time. Does not bode well for my questions, huh? So I wanted to talk a little bit about your use of the word throughout testimony and the written testimony, symmetrical, around 2%, right? And I think you, in your opening statements, referred to total PCE for the trailing 12 months at 1.5%, core 1.6%. What do you mean by symmetry around 2%? What does symmetry mean to you?
So in our longer run, statement of longer run policy goals and monetary policy strategy, we define symmetry to mean that the committee would be concerned if inflation were to run persistently above or below 2%. So it's really a symmetry of concern or of intention as opposed to outcome.
Right. And so over the last 10 years, right, it's run persistently below 2%. Does that imply a willingness or acceptability for inflation to run for a period of time moderately or slightly above 2%, given some of the disinflationary pressures from around the world?
So under our current framework, all it says is that if inflation is above 2% or below 2%, we would look at that symmetrically and we would use our tools to guide it back
to 2%.
To 2%.
Right.
So, and of course, a central question we're asking as part of our monetary policy review is whether that's the right way to think about it, when in fact all of the deviations from 2% have been below, not above.
Right.
And so inflation has been averaging less than 2%. Right.
Certainly, I mean, it's unmistakable when you look around the world, right? There's a lot of traps associated with very low inflation and how persistent that seems to be around the world. I know that's some concern that you've expressed as well on many occasions, that we don't want to get mired in very low inflation. We want to have stable prices, but stable around that 2%. As you think about where the economy is today, think about where inflationary pressures are today, is there a desire to ensure we don't fall into the same trap by pushing the economy faster, being more accommodating in monetary policy to push that 2%, as you said, if it's symmetrical, to push inflation to that 2%?
Well,
Through the indirect means that you have available to you.
I'm sorry?
Yeah, through the indirect means that you have available to you to manage inflation expectations going forward.
I think we want inflation to be symmetrically at 2% and not at 1.7 or 1.8%, because that will ultimately, lower inflation will ultimately work its way into expectations and into short-term interest rates.
Right.
And that'll mean we have less, and plus, so we really do want to have inflation symmetrically at 2%.
Right. And so one of the things that you've talked about is people's expectations for future inflation, which have been very much anchored by their recent history with inflation, right? That recent history over the past 10 years has been below 2% inflation. And in order to move people's expectations going forward, they need to experience slightly faster paces of inflation. I think most research continues to indicate that recent experience informs expectations going forward. So I just wanted to come back to and better understand what you were saying around that symmetrical. Like, the goal is to push inflation up to 2%, or have a willingness or tolerance up to 2%, and if it should run above 2%, to be able to bring it back down to 2%. Is that what you mean by?
Well, I want to draw a distinction between our current framework is the one I described for you, where we would always be pushing back for 2%. We're looking at different ways to, and that, by the way, that framework seems to have achieved errors on one side, which are consistent with the framework.
Correct.
And we're asking the question whether that's the right way to keep doing it, or whether we should be looking at something which produces more symmetric outcomes. We haven't made that decision.
Right.
That's one of the fundamental things we're looking at as part of this.
And one of the dialogues I know that we've had in the past, and I certainly want to continue, especially publicly, to encourage you to continue that research and developing that framework. I think it is really important, given all the pressures that we see around the world and some of the other developed countries that have fallen into this very low, persistent low inflation, that we should really think about how we continue to manage what we're doing in monetary policy and reflecting those concerns. And so I appreciate the work that you're doing. One last question. What have we learned over the past 10 years about the limits of monetary policy, and how do those limits inform what you believe the next steps might be with regard to monetary policy? Well, if you can answer that broad question in 12 seconds.
I will. I would say it's not a good thing to have monetary policy being the main game in town, let alone the only game in town. Fiscal policy is very powerful and more powerful, and it's there come times, for example, after the financial crisis, where you need fiscal policy to really lift the economy.
Right.
So it's not a good thing to have monetary policy be responsible exclusively for things, and it shouldn't be. And
Well, thank you for being here, and thank you for your great work.
Mr. Himes, the gentleman from Connecticut, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Mr. Chairman, for being here. Good morning. Thank you for your testimony. I've got two questions, one on monetary policy, one on the broader regulatory environment around the banks. Let's start with just a couple of minutes, though. Let's wake up the room with a discussion of interest paid on excess reserves. The Fed's policy obviously changed pretty dramatically in 2008. If the numbers I'm reading are correct, excess reserves today are in the neighborhood of $1.5 trillion. I have a couple of sort of intuitive, at least, concerns with that. That obviously has a pretty dramatic effect on liquidity in the system. It creates a business model for banks, obviously, who can essentially get risk-free money from the Fed in a way that is not available to my constituents. But I suppose what really concerns me in the context of monetary policy, I'm sure you're aware of a report that was published by the Minneapolis Fed, in which the individual who wrote it, and I'll just quote the report, what potentially matters about high excess reserves is that they provide a means by which decisions made by banks, not those made by the monetary authority, could increase inflation-inducing liquidity dramatically and quickly. So my question is, at a minimum, if that is true, that could be a significant impairment of the FOMC's ability to actually control monetary policy. So my question is, what is the future of the policy with respect to interest paid on excess reserves?
I'm not familiar with that paper from the Federal Reserve Bank of Minneapolis, but as I'm sure you're aware, during the financial crisis, we bought a lot of assets, and the offsetting liability, the way we paid for it is by issuing reserves. At the same time, we vastly increased the required liquidity that largest financial institutions have to hold, vastly increased that, and many of them choose to hold reserves. So demand for reserves even after the balance sheet shrinks, is so much higher. And we're actually trying to find what that demand is, and it might be somewhere a bit below the current range that it's in.
But sir, the demand obviously is to some extent driven by the rate that is paid on those reserves. You control the demand for reserves above and beyond required reserves.
To some extent we do, though, but banks choose to hold, they have to hold a certain quantity. They could also hold treasuries, but they like reserves because they're highly liquid, and it's not, they pay the same as treasuries, by the way, roughly the same. So in terms of IOER, though, the thing is, in our framework, in our chosen framework for conducting monetary policy, IOER is the critical rate. It's how we manage, it's the administered rate, that's how we manage monetary policy. We've been doing that for really 10 years from now, and we've decided earlier this year that we would remain in that system. Getting to a system where you, instead of using an administered rate, you manage the quantity of reserves on the edge of scarcity and set the price that way, which is what we did, would be very, very tough given the level of demand for reserves.
So should we, I mean, as you know, there was a fairly dramatic policy shift in 2008. Some have said that the amount of interest paid on excess reserves was well in excess of what Congress envisioned in the time and in the legislation of 2006. Is this now a status quo monetary policy tool that the Congress should anticipate works in conjunction with your control of other rates?
Absolutely. This is our principal tool for implementing monetary policy, is interest on excess reserves.
Okay, let me shift, just because time is short, to a broader regulatory question. We have heard from CEOs of banks, we've heard from the vice chairman and others that, generally speaking, the banking system is safe and sound, well capitalized. When the CEOs of the large banks were in front of this committee a couple of months ago, they identified two things with some consistency as being of concern. One was leveraged lending, which is a bit odd because most leveraged loans get put into CLOs, which then get taken outside of the banking system. But interestingly, they also said shadow banking. Now, by definition, you don't have a lot of control over shadow banking. But given the consistency of that, given the fact that an awful lot of the risk from leveraged lending, which they identified as risky, concerning, I should say, not risky, concerning, how are you thinking about potential risk bubbling up in the broader shadow banking system?
We, well, in particularly on leveraged lending, we've called out the risk. The risk is not so much located in the banks. It's located, as you know, in CLOs, mutual funds, hedge funds, insurance companies, and all those things. So, and it's not subject, those vehicles are not subject to runs in the same way that pre-crisis banks were and really no longer are. So the systemic risk question is not a prominent one. It's more a macroeconomic question. So if the corporate sector gets very highly levered, then in the event of a downturn, you will see companies that have to lay off workers and stop spending and that kind of thing. So it could be a macroeconomic multiplier. You know, this is a project that the Financial Stability Oversight Council is working on now, and also the Financial Stability Board globally is looking carefully at leveraged lending, and you know, we think it's something that requires serious monitoring.
Thank you. I'm out of time. Thank you, Mr. Chairman.
Mr. Gonzalez, the gentleman from Ohio, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being here today. First, I want to thank you on your transparency and all the data that you provide. I think you know, there's a sense that some of these decisions may be made behind closed doors, but I think when you're transparent and open about what the data is that you're looking at, I think that helps. It certainly helps me to understand. I want to kind of summarize two things that you've talked about with respect to all the data you're looking at currently in interest rate policy. And if I think I'm understanding you correctly, I'm hearing that trade uncertainty and persistent low inflation short of our 2% target are kind of the two biggest bogeys for you, so to speak. Am I summarizing that correctly?
That's
based on
fair.
the current situation? Okay. I think we did a nice job covering the importance of passing USMCA to help from a certainty standpoint. You didn't weigh in on the deal itself, but it certainly makes things more secure or more certain. On the inflation side, it seems to me that in a world where we're still short of our target and we have trade uncertainty, and those are the two biggest factors you're considering, that raising rates would certainly be irresponsible. I would argue for lowering them, but would it be fair to characterize, based on what we're seeing on those two factors specifically, that a strong case could be made for lowering, and not to commit you to that, but is that sort of where things seem to be headed?
So, yes, as I mentioned, we think that uncertainty around trade policy and also global growth, it's not all down to trade policy. There's something going on with growth around the world, particularly around manufacturing and investment and trade. And so that uncertainty is we think, weighing on the domestic economy. It's starting to show up a little bit, we think, in business sentiment readings, which have moved down, and also in weaker business fixed investment. And then, as you pointed out, the other piece of it is inflation. We see the risk of a more prolonged shortfall of inflation from our target. That's not something we desire. It's something we want to avoid.
So it would encourage a more accommodative policy.
And those things do, many on the committee see those things as strengthening the case for a somewhat more accommodative policy.
Thank you. And then I want to shift to the balance sheet a little bit. We haven't really talked about that. So in January, you announced a major shift. I thought it was a major shift in terms of how we were going to manage the rate going forward, which is to shift towards administered rates. We're going to pause the drawdown of the balance sheet. Can you kind of walk me through the logic on that a little bit? My concern here is, are we going to still be prepared to handle another financial crisis if that sort of thing were to happen while we have an expanded balance sheet? And in the long run, do you see us moving more towards going back towards open market operations, which historically has been how we did this?
So actually, since the QE era began, reserves have been super abundant, and we haven't set monetary policy really by,
right.
We took monetary policy to zero, and it couldn't go any lower, and so we didn't have to have scarce reserves. We only had to have scarce reserves when we lifted off in December of 2015, and we didn't, so we used the administered rates, which is IOER. So we've been using them for a long time. It wasn't really a change. What was new, you're right about this, what was new is after having thought about it really for years, we decided after much deliberation that this would be our permanent framework. We think it works well. We think it has a lot of benefits. In terms of room for further quantitative easing, that is just as a, what we'd be buying would be Treasury securities. And the manufacturers are busy, as I understand it. There's plenty of them out there, and there would be no shortage of them to buy. There are questions about the efficacy, and there's a lot of research that's gone on how much quantitative easing affects interest rates and thereby the economy. But I don't see the size of our balance sheet as limiting our ability to buy more, just as a practical matter.
Okay, thanks. And then with my last sort of question, when you look at Libra specifically, I see it as three different things. I see it as Libra, which is a currency, Calibra, which is the wallet. They seem to desire to be a bank, and then the Libra Association itself. As we're evaluating how to approach this, one, are those the three buckets that we should be looking at? And two, what gives you the biggest concern? As you sort of said, let's pause it broadly. And maybe I'm running out of time, so we'll submit this in written questions, but any feedback you have on that will be greatly appreciated by this committee. Thank you. I yield back.
Thank you.
Mr. Lawson, the gentleman from Florida, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Powell, welcome to the committee. Could you elaborate, and you might have, how did the top 1% of U.S. families own 40% of the wealth in this country? How did we get to that particular point? Do you see any kind of balance coming in the future? The top 1% own 40% of the wealth in America. We say we are a very rich country compared to other countries, but how did we get to the point where 1% own 40% of the wealth in this country?
What I've seen and what I've mentioned in my testimony that's troubling is that a couple of things. First, median incomes and lower incomes have stagnated compared to those at the high end. So there was a time not so long ago when there's always a disparity between the wealthiest and the least, but it was nowhere near this large. So what's happened is those people in the middle and at the lower end of the wage and wealth spectrum have seen their wealth and wages move up, but much less than those at the top. And that is, that's troubling. The other thing that's troubling, sort of a separate issue, is lack of mobility. So the chances of being born, if you're born in the bottom 20% of wealth or of anything, you can calculate what are the chances empirically that you'll move into the middle quintile or the top quintile. And they're actually lower in the United States than they are in many other similar advanced economy democracies. So these are troubling things. I would personally put them down to a combination of technology, globalization, and education, really. It comes down to the education system needs to produce people who can take advantage of advancing technology and globalization. And what you've seen is a stagnation in educational attainment in the United States relative to other countries beginning about 40 years ago. And that has been, I think, an underlying force that's driving this phenomenon.
Okay, another question is, recently in June, let's say in Ontario, in Canada, minimum wage went to around $13 and let's say 25 cents an hour. And earlier you stated that our minimum wage at the federal level is around $7 and maybe 25 cents. It hasn't been changed since maybe 2009 or something of this nature. And in your testimony, you said that it's up to Congress to really make that happen. And there's been a lot of discussion on what's going to happen to businesses and so forth. The reason why I say that is in 2020, in Ontario, Canada, they'll go to $15 plus per hour for the economy. Do you see, and you talked about before, by a gradual increase in the minimum wage in this country, it's going to affect businesses to the point that they'll be closing? Because what you see mostly at the end of the year is a lot of these businesses have a very big surplus to invest or pay taxes on. And so what is the difference in passing those increases to their employees instead of giving it back to the federal government or giving the money to some charity? How do you weigh in any on the minimum wage increase as far as the stability of the economy?
We don't really take a position on minimum wage, and the reason is, you know, that there's a lot of research and it shows costs and benefits. It tends to show costs and benefits depending on what you assume and how fast you move. I think how quickly they move up is an important indicator. But when you raise the minimum wage, some people lose their jobs and some people benefit. They get higher wages. And so I think you can look at a range of studies and they'll come up with, as many different economists as study this will have different answers. And you can weigh that, and that's a trade-off that you make. We have never taken a position on minimum wage. It's the classic thing for a legislature to do and not for us to do.
Right, one quick question. Do you ever look at the way credit card companies increase their interest and finance charges compared to the way the economy is going? Credit card companies.
The way credit card companies, do what?
Increase their finance charges compared to the way the economy is going. You know, like the economy is stable right now, but interest rate, and I know I got to close, some of the credit card companies are 28, 29% and so forth. I might have to send you some information on that.
I would be happy to follow up on that with you.
Okay, thank you.
Thank you, Mr. Lawson.
Thank you. Mr. Rose, the gentleman from Tennessee, is now recognized for 5 minutes.
Thank you for being with us today, Chairman Powell. I am a vocal advocate for putting our federal government on a more sustainable fiscal path. Our federal debt now stands at $22 trillion, more than $22 trillion. Interest on that debt is a big federal spending item amounting to about $360 billion last year. That was approximately 8% of all federal spending. Interest on the debt is becoming the fastest rising element of our federal budget. Our net interest expense could increase substantially if and when interest rates eventually return to more historically typical levels. It seems possible that we might even soon spend more on interest than on our national defense. because we have to in order to service our debt. The President's own budget from 2018 forecasted that net interest expense will exceed defense discretionary spending by 2026. It looks like the federal deficit this year will exceed $1 trillion, as it will in the next several years after that, based on current predictions. It is hard to see how the federal government can issue that much new debt without further driving up interest rates. One of your predecessors once said, "There is no question that as deficits go up, it does affect long-term interest rates." He continued, "A rise in the debt increases the amount of interest expenses, which in turn increases the debt still further, and there is an accelerating pattern after you reach a certain point of no return." Could you talk with us today a bit about some of the potential risk to financial stability posed by our current fiscal path, and in particular, current federal spending?
I think the United States federal budget is on an unsustainable path in the sense that spending is growing faster than the economy, and ultimately that becomes unsustainable at some point. I think we're racking up greater and greater debt. I should say the debt is growing faster than the economy. Debt as a percentage of GDP is going up, and that is unsustainable, I meant to say. It's something that we need to get back to and assess, and it's not up to us to say how to do that, what combination of spending and taxes. That is, of course, totally the province of the legislature. But it's something that's important over the longer run, and what will happen if we don't do it is that we'll wind up spending more and more on interest and less on the things that we really need to spend money on, educating our grandchildren and all of the important things that we do for the benefit of the public with federal tax dollars.
What are your views about the Federal Reserve's role in monitoring financial stability risk posed by the deficits?
We do have a broad role in monitoring financial stability. I would say, the four key pillars we look at are leverage in the financial system, leverage away from the banks, funding risk, and asset prices. We don't really think of longer-run fiscal unsustainability as a financial stability risk. It's more of a, we're the world's reserve currency. We keep being able to borrow. My predecessor, who predicted that more debt would lead to higher interest rates, would be surprised to see that with the debt that we have, we still borrow at very low interest rates because we are the world's reserve currency. So we haven't seen higher rates, but to the extent we go on raising debt to GDP, we'll just wind up spending more and more money on interest and less on the things we need.
If you will, talk about the impact of higher interest rates, if in fact deficits lead to higher interest rates, on the stability of the financial system in the aggregate.
Well, I think down the road at some point, rates, ultimately, there's a price to pay here in higher rates. That has to be true at some point, although, Japan has far higher debt to GDP than we do and pays even lower interest rates. So it's hard to say, but ultimately, I think the debt that we're racking up is really going for essentially current consumption, and we're passing the bills on to future generations. And I think our generation's entitled to spend whatever money we think we need for ourselves during our lifetimes, but we really ought to pay for it. We ought to be paying for it rather than passing the bills along to the next generation.
And finally, in 3 seconds, is there a point of no return?
Somewhere way out in the future. There has to be, I think, in principle.
I yield back.
Ms. Tlaib, the gentlewoman from Michigan, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you, Chairman, for coming before our committee. As you know, I represent Michigan, which faces strong headwinds in the current climate right now, and the auto industry is at a disadvantage with the current trade war with China. In addition, automakers have been laying off workers as they adapt to products to fit their emerging technologies and market trends, and really at the core is corporate greed. But What we saw between, I think in Wayne County and the Detroit area, we saw unemployment rose between April 2018 and April 2019 from 4.2% to 4.6%. Given that Detroit area still hasn't fully recovered, why should we believe that the Federal Reserve has the tools to prevent another deep downturn?
Let me say, we do understand that when we talk about national level unemployment rates, we completely understand that that is not true in all parts of the country, in all regions of the country, in all demographics of the country. And we try to, when we do this at the FOMC, we always have presentations that call out those disparities. Ultimately, if we were to face another, your question really is, do we have the tools to address another severe downturn? We don't expect a severe downturn. If we had one, we would use our tools as aggressively as we needed to do that, and that would include all the tools in our toolkit, including interest rates, forward guidance, the balance sheet in various forms, and whatever else we could devise. And I do think our tools would be adequate.
So if we had another recession and interest will be low or cut to zero, and then we flounder, and should we expect that it will take another 10 years for unemployment to recover? Should the people in my district be expected to wait for a decade for a job? I mean, we see this shift in certain parts, not only in Detroit, but even in the Wayne County community surrounding the city of Detroit.
I would think not. So remember that the Great Recession was the most severe in a very long time, and we saw unemployment go to 10%. We hadn't seen that since the early 80s, and you're starting now at 3.7%. If you take a typical recession, a more typical recession, not like the Great Recession.
Yeah, but we're still at 5% in my district. So what additional tools or authority do you need to prevent another downturn? I mean, you talked about tools and so forth. I mean, what specifically, and again, direct us to what we can do to support making sure that our families are able to provide.
I think we have the tools we need. I think what we would hope for is support from fiscal policy, which is to say, supportive fiscal policy that would, support monetary policy in a downturn.
Well, in the last recession, the feds stepped in to ensure that the corporations borrowing in the commercial paper market would still get credit. When governments in places like Detroit or Puerto Rico cannot issue bonds at reasonable terms, that has real consequences, like the inability to provide safe water in my district, for instance, a lot of infrastructure issues. If the Fed is responsible for ensuring that businesses have access to credit through the commercial paper markets, why isn't it equally important to ensure that state and local governments have access to credit?
We don't have authority, I don't believe, to lend to state and local governments. I think we try.
That could be a tool.
I don't think we want that authority. I think I think that's something for Congress to do. I think we don't want to be picking winners and losers. We want to be helping the economy broadly to the maximum extent possible. In the financial crisis.
What's the difference between we do it for corporations? Why is there a different standard? And this is I'm genuinely really curious.
So what you had credit markets, for example, that financed auto receivables and commercial paper and things like that that were failing and breaking down, and the economy was grinding to a halt. And so we devised programs to support, to reopen the capital markets in a way, without regard to who the borrowers were or picking a particular kind of borrower. We had to do that, and that's really what got the economy back on.
But we could do something similar into state and local governments.
We can talk about this.
I know. I come from a city, the first, I think, ever to file for bankruptcy. The people that were actually directly hurt and still continue to hurt are pensioners. We still haven't been able to really, the 7.2 miles of downtown and some of the surrounding neighborhoods have been able to get investments, but you still see a deterioration, and it's directly tied to unemployment. Thank you, Madam Speaker.
Thank you. Mr. Stiles, the gentleman from Wisconsin, is recognized for 5 minutes.
Thank you very much, Chair Waters, and thank you for being here, Chairman Powell. In your opening remarks, you stated that you strongly support the maximum employment mandate and that overall the national labor market's healthy. You noted the unemployment rate was 3.9% in December, has ticked down to 3.7% in June. It's actually 2.8% in my home state of Wisconsin. You also noted that employers are hiring lower skilled workers and training them. I view this as a quite positive step. Also, in your opening remarks, you identified key risks that you're tracking, including Brexit, trade instability, and rising debt. What I did not hear you bring up is a proposed $15 national minimum wage that some of my colleagues are advocating. As you may know, the CBO recently analyzed this proposal to increase the minimum wage. The report found that a federal minimum wage increase to $15 an hour may cause 1.3 million Americans to lose their jobs. And in a worst-case scenario, 3.7 million Americans could lose their job. That's even more than the entire civilian workforce in the state of Wisconsin, which is 3.1 million workers. How would the Fed respond to the impact of a $15 minimum wage, both on inflation and real wages, as well as the precipitous fall in employment outlined in that CBO report?
We see the question of minimum wage is one that is squarely in your court and not ours. There are many, many studies of minimum wages and their effects on the economy. There doesn't tend to be a consensus, but they do all tend to show, to some degree, some people will lose their jobs and other people will benefit. And so if I were sitting in your chair, I'd be looking at 20 of these studies and I would try to get a sense of what the right trade-off is and whether you would be willing to make it. It's not a question for the Fed, and without knowing, we just don't take a position on that. So, and it's not something. I imagine it would be challenging to make an aggregate assessment without sort of taking a point estimate in what is a highly uncertain range of possibilities.
I appreciate that. Could you even comment if the discussion on the $15 minimum wage would create the type of uncertainty that may slow hiring?
I'm just not going to. It's really not for us to be a referee on the question of the federal minimum wage. We have not done that, and it's just not something we're going to do.
Fair enough. Fair enough. Let me shift gears, Chairman Powell. I'd like to ask you about an issue that's been a major focus for many members of this committee: the international insurance capital standards. In previous appearances, you've assured us that the Fed wants to negotiate an international agreement that works with our regulatory system. As you know, we expect the final version of the ICS to be completed at an International Association of Insurance Supervisors meeting this November. Can you comment as to what instructions you're providing to your staff who are negotiating the ICS to ensure that the U.S. regulatory approach is formally recognized?
So we coordinate very heavily with the Office of Insurance over at Treasury and very much with the state insurance regulators, which is where a lot of the regulation happens in our system, really all the regulation. And I think we're all resoundingly agreed that whatever capital standard is adopted has to work for the U.S. system. The U.S. has a particular system of regulation for insurance companies based at the state level, and anything that gets adopted internationally simply has to work for the United States system, or we can't adopt it.
Is the Fed prepared to then oppose the ICS if it was unsuccessful in achieving formal equivalency for the U.S. regulatory system?
Yeah, I think we're clear that whatever is adopted has to work for our system.
I appreciate that. I appreciate your time today, and I yield back. Thank you.
Thank you.
Ms. Asney, the gentlewoman from, where is she from? Is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chairman Powell, for being here. And I am loud and proud about Iowa, a great state that it is. Chairman, you said that in February that income inequality would be our economy's biggest challenge for the next 10 years, and I couldn't agree with you more. You also said that income decreased for people in the middle and bottom end of the income spectrum, while growth at the top has been very strong, and that's something I hear a lot when I'm talking to folks in Iowa. And to make that disparity even more clear, the Fed recently put out its distributional financial accounts showing that over the last 30 years, the total wealth of the top 1% has increased by more than $21 trillion, while the total wealth at the bottom half of Americans has actually gone down. My colleague, Mr. Lawson, asked why this was happening. I'd like to expand on that and ask you, is that inequality something that should be considered when setting monetary policy?
We try to inform ourselves about what's really happening in the economy. That's a lot of what we do, and so this is an important factor. We don't actually have the tools to directly address these issues. I think they're more around education and skills. The principal way we can get at this issue, though, really is to take seriously Congress's order that we achieve maximum employment, because as you can see, I assume you can see in your communities that the expansion is now reaching groups that are at the margin of the labor force, and that's because we're pushing ahead and having a very long expansion with quite low unemployment, and that's really benefiting these people at the margins.
So you mentioned a couple of what I believe are possible solutions. You said education and training, I believe. Can you expand on that a little bit, or what other solutions do you see to help us with this inequality?
You know, I think I guess my underlying model of the problem is that there is no shortage in the world of good jobs. We just have to produce qualified workers who can live at the standard of a wealthy country and do the work they can do, and that means better education. It's easy to say, it's very hard to do, but we need workers who can compete with the other advanced economies for the good jobs. It's manufacturing jobs, it's a lot of service economy jobs, and it's not easy to do. Fixing the educational system and improving it is a very challenging thing. I've spent no small amount of time on that earlier in my life. But I think that is it. At the end of the day, the country is its educational system. And the people who are in the country, they're a product of that system, and we need to get ours producing people who can compete in the global economy, and I think that's at the bottom of the pile. That's the important driver.
I appreciate that. Let's pivot slightly to look at regional differences. Iowa's per capita income is more than $1,500 below the national average, while New York's is almost $5,000 higher. I'm concerned that too much of the discussion focuses strictly on the rural-urban divide, and I certainly know that my district has rural and urban in it. But I'd also like to raise the issue of regional shifts within the economic growth moving to the coasts. Could you talk a little bit about how that income inequality that you've mentioned as one of our biggest challenges interacts with regional inequality?
Yes, we actually had a box in the February monetary policy report on disparities between rural and urban, if that goes to your question. And they've gotten worse over time since the financial crisis. And there are just these underlying drivers that we're not at all sure of. There's no widely accepted explanation, but younger generation appears to want to live in cities, and so they're moving into cities. They're moving out of rural areas, and it's leading to people. In other words, people who can move to cities do, and they get because that's where the jobs are and that's where the growth has been. It's a phenomenon that we've been seeing for some time, and it's gotten worse in the last decade.
So, do you have any particular solutions that we should be looking at?
I don't, unfortunately.
Okay. Well, fortunately, I think several of us from these rural areas are working on this, so I'm hoping that we can make an impact there. But I thank you. One thing that you didn't quite get to, you mentioned rural-urban again, but a little bit more about the regional shift. So, we've got a lot of opportunity in states that are in the Midwest, but we don't have as much access to that opportunity that some of our coastal areas have. What are your solutions there?
I don't know that we have those tools. I will say we have researchers who are doing a lot of good work in this area, though, and we'd be happy to connect you with them. I'd be happy to connect you with them.
Appreciate that.
Be able to help.
Thank you.
Thank you.
The gentleman from Virginia, Mr. Riggleman, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you, Chairman Powell, for appearing here today. It's good to see you, sir. We were talking a little bit earlier about fiscal policy, and one of the good things about going near the end is I get to hear a lot of good things. Talking about fiscal policy and trying to prevent a downturn, had a couple questions to talk about incentivizing investment, sort of for the average American. And looking at policy, just some thoughts about, looking at, is it higher taxes, lower taxes? Is it the USMCA or something like CECL, that we've discussed before? What are some of the quick take on some of the policies that would help as far as economic growth for the average American? And I just wanted to get, some of your thoughts on that.
I think, generally, I think we need policies that will, pardon me, policies that will support labor force participation, policies that will qualify people to hold jobs and progress through their careers. That's a big thing. That's a place where the United States lags other comparable economies. And it's really something we need a national strategy to work on, is how can we raise labor force participation? It won't be any one thing, it'll be a range of things. The other piece of it is productivity. And productivity is really a combination of a couple things. One is incentives for investment in technology, which drives productivity. I think basic research by the government has actually been an underlying driver over long periods of time. In addition, it's skills and aptitudes of the workforce, which we've been talking about. It's, more productive workers have more skills and more training and that kind of thing. So, you can break it down into labor force participation and productivity. Those are the two things that really determine the country's longer run growth, as of course population growth as well. But assuming a level of population growth, it's labor force participation and productivity.
Thank you. I think we talked, you said 62.8% of the people really probably support 100% of the population, which I thought was a very interesting stat when we discussed that. And I also want to commend you and thank you and your colleagues at the Fed for the very substantial support, guidance, and collaboration you provided to the private sector in the area of faster payments. And this successful public-private partnership has been critically important, I think, in making real-time payments a reality in the U.S., so thank you for that. And I also want to commend the Fed for its proposal to facilitate private sector real-time payment solutions by providing additional liquidity services, which I understand could be effectuated by extending the operating hours of the FedWire Fund service. But I do have some concerns, Mr. Chairman, regarding the other part of your proposal that envisions the Fed itself entering the market for faster payments as a direct competitor of the private sector. And my understanding is that the Fed seeks to justify this potential action in part on the perceived need for resiliency, which I believe raises several important questions. And I would say first, it's the notion that having two systems would provide resiliency necessarily assumes that every bank in the country, or at least an overwhelming majority of them, would have to connect to two systems, the private sector system and the yet-to-be-built government-run system. And this is just based on my experience in big data when you're talking about what I've had to do in the military with electronic warfare. And looking at this and actually trying to interoperate systems. And I think this would create enormous inefficiencies and impose needless costs on the American taxpayer and the private sector, unless, of course, the Fed-run system would be fully interoperable with all the private sector alternatives. So my question is, if I'm a community banker in Virginia, where I'm from, and I participate on the Fed system, what guarantees can you give that community bank today and the two systems will be fully interoperable? And if there are none, then what is the purpose of having a second government-run system?
So as I think you know, this was based on a proposal from the Faster Payments Task Force, which had very broad representation, including the smaller banks who were quite supportive of this idea. We asked for public comment on this. We're reviewing that comment. We got, 400 comment letters or 900 or something, a lot of comment letters, and so we're in the middle of that decision-making process. In terms of interoperability, and again, it was the community banks who strongly pushed the Fed to move forward with this. In terms of interoperability, it's a good issue, a good question, and we'll need to work to make that happen, at least to the level that it's functional. It may not be perfect, but we'll certainly be. If we move forward with this, we'd be certainly looking at that as a characteristic to achieve.
Thank you. And I think it goes back to resiliency for me. And I know, and I think it's the concern about resiliency that I had, and when we had our discussion here in committee, is that if there are concerns about resiliency, and it's just based on my experience in the private sector when it comes to big data, couldn't you probably address those concerns through the regulatory and supervisor authority that already exists in your space? And that's what I was getting to here. If we're talking about resiliency with the multiple data centers and redundant systems that actually could be a problem with interoperability, do you think resiliency could be something that's a function of what you're doing right now and keeping with one sort of faster time payment system? I think I'm done.
The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Madam Chairman, and thank you, Chairman Powell, for appearing before the committee today. The Federal Reserve can do more to support the needs of hardworking American families. As it stands, working families wait days at a time just to have their checks clear. And when you are living paycheck to paycheck and rent is due the first of the month, there can be no room for error. As a central bank in America, the Federal Reserve has a responsibility to speed up the process of clearing payments. I want to bring up a report that was issued 2 years ago, the Faster Payments Task Force. In that report, the task force called for a payment system in the United States that is faster, ubiquitous, broadly inclusive, safe, highly secure, and efficient by 2020. Mr. Chairman, 2020 is less than 6 months away. Yes or no, will we have a faster payment system by then?
No, we're working on it, but we're not going to be done by 2020, I would say. But we're getting there.
The task force also concluded that broad access to settlement services will help level the playing field and enhance competition among providers of faster payment services. Yes or no, do you agree that this is an issue of accessibility and equality?
I do agree with that. That's one of our principal motivating factors.
And so would the Fed like to see a world where all Americans have access to faster, secure payments?
Yes, we would. That's why we've been working on, you mentioned that report. This is a project that's been going on for 5 years. And
right.
Goes on.
If you can instantly clear payments between the accounts of commercial banks held within the Fed, why not consumers writ large? What's the delay?
Well, it's not a, it's a service that hasn't existed. It's existed for banks. Immediately available funds has existed for banks. We really, we don't have plenary authority over the payment system as some other central banks do, but we convened a group of people and institutions maybe 5, 6 years ago, and we said, let's work toward this. And so that's the report you saw was I think the last report that we issued, and we're now working to implement some of the recommendations.
Yes, Mr. Chairman, just trying to better understand the delay in the implementations of this report. Have you received any pushback from any businesses, particularly the credit card industry?
You know, I think we're determined to do what we see the right thing as. We're not looking.
Have you received any pushback specifically from the credit card industry?
I have not personally, no. I think that
so a faster
count on businesses to advocate for their own well-being, though.
Sure. Do you agree that our country's continued lack of a real-time payment system is being exploited by credit card companies like MasterCard and Visa, and also outside of that industry by Facebook to create a digital currency?
I wouldn't want to use those terms, no. I think people operate in the environment that they have. We're trying to create an environment that does have faster payments broadly available, and we think that's a better environment for the reasons you articulated.
Yeah, I mean, I really do see a faster payment system simply as a public good, and the lack of action here creates a real void in the lives of consumers everywhere, and these voids are increasingly being exploited by companies looking to operate as financial institutions without the guardrails. Facebook's Libra is being trotted as a solution to the unbanked. However, I struggle to see how ceding the functions of a central bank to a private company solves an issue of resources. Instead, we should be using pre-existing infrastructure to ensure that all people have the ability to safely and securely and with no cost access and move their money 24/7, 365 days a year. So again, let's not lose sight of the plot. Mr. Chairman, and the plot is the American people, and I hope to see your organization become more reflective of the lived experiences and the everyday needs of Americans. Thank you, and I yield back.
Thank you. The gentleman from Wisconsin, Mr. Duffy, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, up on your left-hand corner, welcome. One of my colleagues in their statements said that the President has implemented harmful economic policies. In your assessment, I think you said the economy is doing quite well. Is that correct?
Yes, I'd say the economy has performed, I said, reasonably well so far this year. Yes.
Right, last quarter was 3.1% growth. Pretty great, isn't it?
Just if you take it through the middle of the year, we'll have growth probably in the mid-2s, and yeah, that's a solid performance.
Okay, great. Where I come from, obviously we'd like our rural communities to grow as well as our urban communities, but by and large, the biggest complaint that I hear from my employers is that they don't have enough labor. they can't get people in to their shops to fill the positions that are open. And then there's some that'll come in and they don't actually want to work, which leads me to immigration, but I'm not going to go there with you. We had some problems in immigration. But there's competition for labor. And when there's competition for labor, don't you see salaries rise, hourly wages rise when there's competition for labor?
Yes.
Or am I wrong on that?
It's very interesting. You know, we have seen wages moving up, and we do hear lots of reports like what you just said about, you know, labor shortages and can't find qualified people. We would have expected to see wages move up more. They are moving up at a healthy level, you know, on average a little more than 3%. That's a good thing. But yeah, you would want a tight labor market to produce solid wages.
Is this a fairly tight labor market?
It is by almost every measure. I would say that the thing that doesn't really show the tightness through is the wages, which could be higher.
In a tight labor market, if I have a person who's making $12 an hour, but they're actually worth $15 an hour, what do you think happens?
Well, in economic theory, they should be earning $15 an hour. If their marginal product is $15,
they'll leave one job and probably go to someone else that'll pay them $15 an hour, right?
Yeah.
Because everyone's looking for labor. But if a guy's making $15 an hour, but maybe only worth 11, what happens?
Well,
they might get fired, right?
Yeah.
Or you might automate. So the markets actually work to pay people the value of the services that they provide the company, and that especially happens in a tight labor market, which I know you won't make the point on a $15 minimum wage, but my concern is that if we increase that too high and we have people who aren't at the value of $15 an hour, they'll lose their jobs and fall into deeper despair. That's my concern. With regard to, I'm going to switch gears on you. In regard to trade, you're not commenting, I know, on the policies of the president with regard to trade, but you look at our long-term horizon. You've mentioned debt and the problems we're going to have. But with regard to trade, if we have countries that will steal our technology, so you have a company that invests $500 million in a new technology, and someone steals it from you and just has to pay a hacker in a basement, and then you come to market with the same product at zero cost versus your $500 million, how do we compete in the long run with that environment? Or if you have a country that manipulates their currency to make sure we can't have some equilibrium with regard to our trade, how do you deal with countries like that, but for the policies that the president has pushed?
Those are entirely appropriate considerations for those who have responsibility for trade policy.
Would it concern you for the long-term health of the American economy if people are stealing our technology or cheating us or manipulating their currency? Would that concern you?
I have to say we are very unusual in a democracy that we have this independence to do our jobs, and I think that means we need to stay in our lane. I try very hard not to get pulled into things that we're not responsible for. So I'm just going to have to say that.
With regard to, someone mentioned corporate greed. We want to see companies and individuals behave responsibly and honorably, but we also want them to make a profit, right? Do you have an objection to companies and individuals making a profit, making money?
Well, we do have a market-based system.
And if they make too much, is that a problem for you?
It's not.
And if so, how much is too much?
Not for us to judge.
Okay. So do you support a market economy? I think that's a good thing.
I think our economy has been market-based, and I think that's served the public well.
And probably the greatest economy that's existed on the face of the earth. Fair to say? Yeah? Okay, I yield back.
Ms. Ocasio-Cortez, the gentlewoman from New York, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you so much, Mr. Powell, for coming in today. The Federal Reserve's mandate, one of their mandates, is to maintain price stability and maximum employment. Is that fair to say?
Yes.
And a lot of folks would interpret that as meaning to aim for the lowest unemployment rate possible without runaway inflation, correct?
Yes, generally.
So I kind of wanted to dig in today with you a little bit about this relationship between unemployment rates and inflation. In early 2014, the Federal Reserve believed that the long-run unemployment rate was around 5.4%. In early 2018, it was estimated that this was now around 4.5%. Now the estimate is around 4.2%. What is the current unemployment rate today?
3.7%.
3.7%. So what we had previously thought of, perhaps as far back as 2014, as a long-run unemployment rate is around 5.4%. What we're currently experiencing is 3.7, lower than that estimate. But unemployment has fallen about 3 full points since 2014. But inflation is no higher today than it was 5 years ago. Given these facts, do you think it's possible that the Fed's estimates of the lowest sustainable unemployment rate may have been too high?
Absolutely.
So we overshot in what our long-run unemployment rate is.
I think we've learned, as you pointed out, that you can't identify, this is something you can't identify directly. I think we've learned that it's lower than we thought, substantially lower than we thought in the past.
And I've been seeing lately that economists are increasingly worried that the idea of a Phillips curve that links unemployment and inflation is no longer describing what is happening in today's economy. Have you been considering on that? What are your thoughts on that?
Yeah, very much so. We spend a great deal of time on that. The connection between slack in the economy, or the level of unemployment, and inflation was very strong if you go back 50 years, and it's gotten weaker and weaker and weaker to the point where it's a faint heartbeat that you can hear now. It's still there. You can see it at state-level data and things like that. But I think we really have learned, though, that the economy can sustain much lower unemployment than we thought without troubling levels of inflation. And I think I would look at today's level of unemployment as well within the range of potential estimates, of plausible estimates of what the natural rate of unemployment is.
So why do we think that we're seeing this decoupling in a relationship that we had seen in the economy decades ago?
So one reason is just that inflation expectations are so settled and that's what we think drives inflation. That, for example, when unemployment went way up, you didn't see inflation go down.
Right.
And you don't see inflation reacting to unemployment the way it has, because inflation just seems to be very anchored.
Do you think that could have implications in terms of policy making, that there's perhaps room for increased tolerance of policies that have historically been thought to drive inflation or increase inflation? You know, one of the arguments about minimum wage or other policies that directly target middle-class Americans is that they could drive inflation. Do you think that decoupling is something that we should consider in modern policy considerations?
Yeah, I think again, I wouldn't want to get into the minimum wage discussion directly, but I think we've learned that inflation, that really downward pressure on inflation around the globe and here is stronger than we had thought. You see countries all over the world not getting, being below their inflation targets, whereas when I was young, they were always above. Now they're always below. And the United States has done better than other countries, but we're still below our target.
And thank you. I have one last question. Earlier, you had suggested that in the event of a recession or a contraction, we'd like to see more fiscal policy that supports monetary policy. Can you further articulate what some of those fiscal options and considerations should be in terms of specific options that we should consider?
So I was referring really to a severe or significant downturn, and if that were to happen, then I think it would be important that fiscal policy come into play, and so there are automatic stabilizers that happen. But in addition, things were done at the beginning of the financial crisis in terms of spending increases and tax cuts that helped to replace the demand that had been lost in the private sector and get us through a really rough patch. Something like that. But those are things I would reserve for pretty severe downturns.
Thank you very much.
Thank you.
Mr. Barr, the gentleman from Kentucky, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and Chairman Powell, welcome back to the committee. And let me first just say I appreciate my colleague from New York recognizing that the strong Trump economy has not produced inflation
challenging the credibility of the Phillips curve. Let me also say, without quibbling about the details, I think that you're doing an outstanding job, Chairman Powell. And I want to especially appreciate the much improved communications with Congress about the direction of monetary policy. And so I do want to take up this issue of Fed independence, because so much has been made in the media of President Trump's criticism of Fed policy in recent months, and his reference to quantitative tightening, his criticism of so-called quantitative tightening. As you will recall, many members of this committee, especially on this side of the aisle, criticized your predecessors for overly accommodative monetary policy for an extended period of time, so-called quantitative easing. And so what I want to just say is that my view is that all of this feedback from both the executive branch and the legislative branch is a necessary and constructive part of oversight, and is simply part of holding the Fed accountable, and that it in no way compromises Fed independence, since you and other governors are given 14-year terms with a provision that makes you removable only for cause. Do you agree or disagree with that?
I would just say it this way, that we're completely and totally focused on carrying out our jobs, and nothing really will distract us from that. Our accountability in our system really does lie, though, with this committee and with the other committee on the Senate side. So you have oversight over us. In a lot of other systems, it is the finance ministry. But in our system of government, it's Congress.
Yeah, my only point is that criticism from Congress or the President does not, in my view, in any way compromise your independence. Mr. Chairman, I heard the economist Arthur Laffer say over the weekend that the Fed really doesn't set interest rates, that it follows interest rates. I thought this was an interesting comment, especially in light of low long-term rates and the inverted yield curve. Has the case for lowering the Fed funds rate strengthened because the Fed is actually following rates as opposed to setting them?
You know, I wouldn't say that. I didn't see that comment, so I can't react to it. But I wouldn't say it quite that way. Our focus is on real economy values, in particular maximum employment and stable prices. So we use our monetary policy tools to achieve that. And we know that our policy works through financial conditions, so we look at a broad range of financial conditions. They do matter for us. What really matters is if there are big changes in financial conditions and they're sustained for a period of time.
Where are we today in terms of the proximity of the Fed funds rate to the neutral rate?
That's another one where we can only estimate the neutral rate, as you well know, and it's interesting. Estimates of that have come down as well. I would point out that we publish the medians in our summary of economic projections every quarter. We publish the medians of the committee, and that number has come down by 50 basis points since September of last year. So the median estimate is now 2.5% nominal, which would be about 0.5% real, and whereas it was 3% back in September. So we're learning. We're always learning about the natural rate of unemployment and about the neutral rate of interest. And right now, understand that it is estimated within fairly broad uncertainty bounds.
As you know, I've been critical of previous Fed positions or policy that I would characterize as overly improvisational. As you communicate and forecast where Fed policy is going, and you talk about in your testimony that the case for a more accommodative policy, that argument is strengthening. I appreciate that because I think it's habituating the markets as opposed to surprises, and I think that's very important for the stability of our financial system. Last question, you obviously cite in your testimony uncertainties in trade developments as perhaps one of the reasons why the case for a more accommodative policy has strengthened in recent months. What would passage by the Congress of USMCA and enactment of USMCA do in terms of the overall economic outlook and also the future trajectory of monetary policy?
I think it would remove uncertainty about our trade policy with Mexico and Canada to have that pass, and I think that would be a positive thing. Of course, I wouldn't comment on the particular merits of it. It wouldn't be appropriate, but I would say the passage of it would remove uncertainty, and I think that would help in the current environment.
I do have actually one final question, and that is, you had responded to my question about the GSIB surcharge, and you said that a proposal to simplify capital requirements for banking firms by integrating a banking firm's supervisory test results into regulatory capital requirements. Where are we on that?
Moving forward, working on it.
Thank you. I yield back.
Ms. Wexton, the gentlewoman from Virginia, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for joining us today. Chairman Powell, do you think that the U.S. should go back to the gold standard for our currency?
Let me say, I wouldn't, this could feasibly be considered commenting on a particular nominee who has recommended that, and of course I would not do that. I will answer your question, but I want to make sure that this isn't interpreted in that way. So no, I don't think that would be a good idea. The idea would be Congress would have to pass a law, and that law would say that our job with monetary policy is to manage the level of the dollar, stabilize the dollar price of gold. And we would then not be looking at maximum employment or stable prices. And there have been plenty of times in the fairly recent history where the price of gold has sent signals that would be quite negative for either of those goals. So I don't think that's something that would be attractive. No other country uses it.
Because it's much more volatile. Linking it to gold would be very volatile.
It's really that it's not connected to our direct, you've assigned us the job of two direct real economy objectives. Maximum employment, stable prices. If you assigned us stabilize the dollar price of gold, monetary policy could do that, but the other things would fluctuate and we wouldn't care. We wouldn't care if unemployment went up or down. That wouldn't be our job anymore. So I think that would be difficult to explain to the public.
And that's not a positive mission for the Fed. You're much better mission for the Fed is what you're doing right now.
Well, this is why every country in the world abandoned the gold standard some decades ago.
Okay. Well, and that reluctance or that desire not to go back to the gold standard is something that you have in common with the CEOs of the seven of the world's globally systemic important banks who were before us in April and said the same thing. But it is worth noting that last week the president nominated Judy Shelton for a seat on the Fed, and she is similar to two of his other would-be nominees in that she does favor a return to the gold standard. So I assume from your earlier answers that you don't share that view.
I don't share that view, but I would never comment on the views or any particular nominee. We do not play a role in the nomination process. It's totally up to the president and the Senate in that, and we just are completely on the sidelines there.
My concerns about Ms. Shelton are not just her questionable views about monetary policy, but she also seems to be, by most accounts, a political opportunist who thinks low rates are bad under Democratic presidents and good under Republican presidents. And that I would caution concern when looking into the nomination and confirmation of this candidate. I do want to talk for a minute about debt. There have been a lot of questions about it. In particular, the debt ceiling. On Monday, the Bipartisan Policy Center projected that the U.S. Treasury could run out of money by early September if Congress doesn't raise the debt ceiling. And that's actually because the government brought in far less in corporate tax revenues this year than was projected as a result of the tax cuts. Because spending's only one side of the ledger, right? We need to look at the revenues. And there's a possibility that the U.S. could default on its debts. What would Congress's failure to raise the debt ceiling, what would that mean for the U.S. economy?
So I think it's essential that Congress raise the debt ceiling in a timely way so that the United States continues to pay all of its bills when and as due. I think any other outcome is unthinkable. We've never failed to pay our bills when due, and so I assume and believe that the debt ceiling will be raised in a timely fashion.
What would it mean for the economy and for interest rates if we failed to do so?
I think it would be very uncertain territory. If the United States were to stop paying its bills, it would be, I wouldn't be able to capture the range of possible negative outcomes from that. The loss of confidence in our ability to run our fiscal house could be substantial. It would be a lot of uncertainty, and I just think it's beyond contemplating that.
Well, and yet we must contemplate it, Mr. Chairman. Thank you, and I agree, and I want to encourage leadership on both sides of the aisle and both chambers of Congress to not wait until the last minute to make sure we raise that ceiling. Thank you. I yield back.
Thank you. Mr. Gooden, the gentleman from Texas is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, the board's done a great deal of work with regard to foreign banking organizations, but I'm concerned there's a lack of harmonization across jurisdictions with respect to these foreign banking jurisdictions. And I just want to make sure that you all are working to ensure that our U.S. firms are not disadvantaged in the foreign marketplace, and could I hear a little more about your plans for that?
So I think here we want to give national treatment, equal treatment to foreign institutions, and we fully expect and anticipate that we will get that from foreign jurisdictions. That's why we give it here. It's, you know, plus we want foreign institutions to come in and do business here and lend capital to people and take part in the capital markets. That only helps our economy, and we want our institutions to be able to take part in foreign economies. Many banks work across international lines now. So it is essential that there be fair treatment for, you know, non-native banks all around the world.
Thank you. I appreciate that stance. Also, in your written testimony, you mentioned trade tensions and slowed global growth as potential threats to the U.S. economy. Between these and the debt ceiling and the lack of consensus in Congress, what would you say are your biggest concerns out of those?
Out of those, I really think that the most important thing is what we've been calling the cross currents, which are the really trade tensions and concerns over slowing growth, global growth around the world. Those are interrelated. There's a box in our monetary policy report that I recommend to you about slowing global growth and manufacturing and investment, which is something we're seeing not just in the United States but around the world. And you know, that is the thing that weighs on our outlook. We see it here. We see weak manufacturing here. We see confidence surveys among businesses. And fortunately, the consumer part of the economy is doing very well, but that's where the weakness is, and that's where the concern. The other things are concerns too, but I would put those at the top of the list, along with low inflation. You know, that's a concern. That's the other half of our mandate, and you know, we are concerned that inflation not run below 2% more persistently than we thought it would.
So putting all that together, the current state of the economy, where you see us going on a scale of 1 to 10, how would you rate where we are with respect to an economy, 1 being bad, 10 being great?
I don't think I'll give you an actual grade, but I will say this. We are in the 11th year of this expansion. That's a first since we began to keep records on this. We're at 3.7% unemployment. That's a 50-year low, and we've been there for 15 months, and there's no reason why that can't continue. We are committed to using our tools to make sure that it does continue. And I just would, again, point out, though, that this expansion is now reaching groups that hadn't been reached in the first few years, and there's a box on that as well in the monetary policy report. All the more reason why it's so important that we keep the expansion going to the maximum extent we can.
Well, I agree with you, and I thank you, and I yield my time back.
Thank you, Madam Chair. Thank you for convening the hearing. And Mr. Powell, thank you for being here, for your thoughtful testimony. And you and the rest of the Board of Governors have a very monumental task, and you've made some good decisions. And I'm also heartened to see that you're maintaining your independence and not allowing yourself to be bullied. Let me just put a couple of things on the record. You know, we've had a lot of discussion here about the CBO report and the minimum wage, and I just want to add something else to the equation, and that is that, yes, there's been some discussion about losses, but I think we need to consider the fact that raising the wage will elevate 27 million low-wage workers, and we really need to be concerned about the fact that so many people are really living at the poverty level. A lot of those folks live in my state of North Carolina. So when we look at the fact that we're going to raise people up, when we look at this $15 that we keep hearing about, I've done the math on it, and it's like $1.55 a year. But anyway, let me move on, having said that, to a question about the unemployment, inequality terms of black unemployment, the overall unemployment rate is about 4%. The unemployment rate for African Americans was about almost 7% in this recent Bureau of Labor Statistic report, which almost doubles the unemployment rate for whites, which is about 3.5% in the same report. And these unemployment rates have been steadily falling since 2011. So what if any analysis does the Federal Reserve do to evaluate the degree to which economic inequality affects the African-American unemployment rate?
Affects the African-American unemployment. Well, let me say, as a feature of our labor markets, African-American unemployment has often run at double. So, and so that means it comes down faster when times are good, and it goes up faster, twice as fast. And so that's not a good feature of our employment market.
Thank you. So what more do you think can be done to ensure that unemployment among minority groups gets as low as white unemployment, and what role can the Federal Reserve play, if any, in reducing these disparities?
The tools that we have, and actually there's a box in the monetary policy report that talks about different, it's not by African Americans, it's by different levels of education, which we can show you, but it does talk about the disparate outcomes for people. In terms of what we can do, I think, again, it goes back to taking seriously the job you've given us, which is maximum employment. So we are seeing, in these tight labor markets, we are seeing communities, including African-American communities, that are being reached by the jobs market in a way that they haven't felt really ever, or it certainly, a very long time ago when we had 3.7% unemployment. It was the late 60s. Right. Which you and I can remember.
Mm-hmm, absolutely.
Not everybody here can.
That's right. I'm a child of the 60s. I'm a baby boomer, and I do remember that. What is supposed to come out of the monetary policy review that happened earlier last month? Were there any important takeaways, and will there be changes to the way that you and the board conduct the monetary policy because of this review?
There may be changes. We haven't decided that yet. We're just into the phase of taking a close look, and we're really looking at the question, are there ways we can change our toolbox or our strategy or our communications that will enable us to better serve the public? And one of the key motivators for that is that rates are so much lower, we're closer to zero. That means we have less room to cut. And are there ways we can, and the people have been thinking about this problem for more than 20 years, so we want to get the best thinking and come out of this with the best ways to serve the public with our toolkit. We may make changes, but that discussion lies ahead of us.
Great. Thank you very much for your service, and again, thank you for not allowing yourself to be bullied. I think that's just really important in terms of the job that you're doing. And Madam Chair, I yield back my time.
Mr. Williams, the gentleman from Texas, is now recognized for 5 minutes.
Thank you, Madam Chairman, and thank you, Mr. Chairman, for being here today. And just as a reminder, as you know, I'm a small business owner, Main Street America, and very much interested in what has happened at the Fed. I wanted also to reiterate my past statements about interest rates. Even the slightest changes can have significant impacts on many parts of the economy. We both remember a time when interest rates were 20%, and the principal balance for these rates compared to today was relatively low. And when a new car cost $6,000 in 1970s, now it's the same vehicle can be $60,000, and with this principal so high, just even the bit of slight increases to the interest rate can really crush businesses with high inventory costs, and it results in lower sales. And we discussed this before, you and I, but I wanted to once again commend you for you having a good pulse on the economy and making the appropriate interest rate adjustments. So before I begin my questions, though, I wanted to make sure nothing has changed since you last came before this committee. Are you still a capitalist, or have you undergone a drastic change of thought and now believe socialism would be a better economic system for our country?
No drastic change.
Thank you. So yesterday in Boston, you stated if the stress tests do not evolve, they risk becoming a compliance exercise, breeding complacency from both supervisors and banks. You continue to say that banks will need to be ready not just for expected risks, but for unexpected ones. You obviously understand the importance of these stress tests to ensure our financial system is resilient. Even so, I heard some criticism that the Fed stress tests have been watered down over the past few years in order to let the biggest banks off easy. So do you believe these stress tests have been made easier since you took over as chairman of the Federal Reserve? And how do these simulated stress scenarios compare in scale relative to the 2008 financial crisis?
I don't believe we've made them easier, or we have no intention of making them easier. We do have the intention of having them evolve, though. I do think we're 10 years into this. I think we've done nine cycles now, and I think there is a risk that if we don't continue to adapt to the markets and to the institutions and to the state of the economy, that they'll become stale and people will get complacent, and you come back in another 10 years and they're not really a factor anymore. They've been a very successful innovation, in maybe the most successful regulatory innovation since the financial crisis, and I think even the banks would agree to that. So we intend them to continue to be strong going forward.
Thank you. In February, when you were in front of this committee, I asked you about the labor force participation rate. Even though there are over 7 million job openings, as an employer, it's hard to hire people right now. You mentioned some factors keeping this number around 63%, such as a skills gap, poor education, and the opioid crisis. Obviously, the Fed has no control over any of these factors, and we must deal with them here in Congress. With that being said, have you noticed any of these factors improving and getting more people back in the workforce since you were last here in February?
I think labor force participation, the labor force participation rate has held up pretty well, and there's a declining trend due to aging in the population. It's at 62.9% now. That's where it was in late 2013. So that's a big gain against the trend. It's a good thing. More anecdotally, we're hearing a lot from folks who live and work in low and moderate income communities that there are work opportunities, and there are companies that are coming in and really want workers, and they're going to look through some of the problematic things people may have had in their lives and hire them anyway. And so we think that's really healthy. And in a tight labor market, if you have a tight labor market that lasts for quite a long time, that's what you're going to get. So we think we do think that that's a relatively new development and a very positive one.
All right, and according to the most recent monetary policy report, consumer spending was down at the beginning of the first quarter, which you touched on earlier this morning, but appears to have picked up, and I can tell you as a business person, we've seen it pick up. So what factors do you see as contributing to this turnaround?
I think it's strong job creation, it's wages moving up, it's, as you mentioned, tight labor market. It's workers who work. We survey workers, and they say that jobs are plentiful. We survey businesses, and they say we can't find workers. So that's a world where the worker and the family is feeling. People are quitting their jobs. It's a world where they're feeling good about the economy, relatively.
Well, and when you have more jobs and workers, it has a tendency to drive up wages, and we see that on Main Street America. Thank you for your service. Appreciate you being here today. I yield my time back.
Thanks, sir.
Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, and thank you, Chairman Powell, for your expertise, your service, and for coming and explaining things to us. I learn a lot when I hear you speak, and I thank you for that. I wanted to examine a little more closely some of the things you talked about. The consumer side looking strong, the business side weakening. And I want to compare that and ask you, what are some of the triggers to the weakening on the business side? As I look at the chart, trade policy uncertainty, you said it's no question uncertainty is elevated. What would greater certainty look like? What are some of the things creating the uncertainty? What would greater certainty look like? And then what would the impact be on the economy?
So we think that the place where uncertainty is showing up is in business investment. Businesses make investments, and those have to work for a longer period of time. When businesses become uncertain about the future and about future demand, they may hold off. They may decide to wait before they build something or buy something, and they may just hold off. So what we're seeing is business fixed investment, which was quite strong. Business investment was very strong right through 17 and most of 18. it's really slowed down now in the middle of the year, and we do connect that. There's no perfect way to identify these things, but we do connect that to trade policy uncertainty and also uncertainty about global growth and weak manufacturing around the world.
What specifically in trade policy do you think is connected to that pulling back on investment?
I think it's just there have been trading. You know, the people who are responsible for trade, and that's not us. We don't criticize them for what they do. We have a broad series of trade discussions going on. If you're a manufacturing company in our economy of any size, the chances are pretty good that your supply chain goes across national borders to Canada or Mexico or China or Vietnam or someplace. And that supply chain is really part of the way you do business, and you just assume that it's working and you can focus on your clients. When the supply chain is called into question, and we hear this a lot from businesses, by the way, when it's called into question, you pull back and you have less certainty about how this is going to work. You may have to change it. Many companies have changed their supply chain away from China now, but
because
many
of
of
the
them had moved to Mexico or Vietnam, and now, so I just think that uncertainty is something that we call out for the economy. But again, I wouldn't want to suggest that in any way is a criticism of those who are conducting the policy. We don't have a responsibility for evaluating that. That's for them.
I understand and appreciate your independence there. I'm hearing the same thing on the ground from my businesses in Montgomery and Berks counties, Pennsylvania. The uncertainty, the fickle trade policy, fickle tariff policy, the punitive tariff policy is driving their conservatism in their own areas. Let me shift to something else that you talked about, and I care deeply about gun violence, the opioid crisis, and I'm wondering through your complex lens, could you talk about the opioid crisis and/or gun violence? One of the recent reports on gun violence says that gun violence in this country costs our economy somewhere in the area of $230 billion a year. And I know you are not involved in gun policy or the opioid crisis policy, but through your lens and through the tools that you're using, what are you seeing? What could we in Congress learn about how we could minimize, reduce that economic impact?
I can probably do a little better talking about opioids, where there's been some great research, including by the late labor economist Alan Kruger, who sadly passed away last year, or maybe earlier this year, about the effect of the opioid crisis. So an extraordinary, if you take the prime age men in certain age groups who are out of the labor force, an extraordinary percentage of them, I think the number was 44%, are taking some kind of painkiller. So it's a big number. It's a big number of people that are on opioids and for the most part missing from the labor force. We all want the U.S. economy to grow faster and be larger, and we want prosperity to be broadly shared. Here are people who are in the prime working years who are on opioids, and it's a national crisis. And I know people are working on it, but it's out there, and there's a human tragedy, but there's also an economic motivation to get these people into the labor force where they can lead healthy lives.
I appreciate that in terms of direct cost to labor, and also if you think about the numbers, 72,000 people in a single year dying of overdose. Think of the lost economic, or the economic impact obviously to the individual family, but then to the communities, to their children and elsewhere. So I thank you very much for your work, and I always learn something from you. Thank you, I yield back.
Thank you. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Madam Chair. And thank you for being here today again, Chairman Powell. You know, and we've discussed many times, the nature of my district. It's agriculture, it's energy, it's capital intensive. So the actions that the Fed takes, the actions the Treasury takes has a very direct impact on my constituency. I'm very, in particular, sensitive about Fed actions because my part of the world suffered the most at the end of the 1920s and the 1930s, before we became far more sophisticated in how we handle these policies. You're the fourth Fed chairman that has appeared before this committee in this capacity since I've been a member. And there's just a handful of us on the back row who go all the way back to Mr. Greenspan. And I found you to be as upfront and as straightforward as anyone could be in your position, and in some ways really quite impressive compared to the things in the past. Now that said, I've also learned in my time to try and focus on things that matter to my people back home, that would make a difference to them, even if sometimes it appears to be down in the weeds. I have a suspicion, a very bright fellow that you are, you know where we're going with this next question. But I have been raising the issue of inter-affiliate initial margin for nearly 5 years now. And while regulators have agreed that the inter-affiliate initial margin requirements are an issue to be addressed, we've not yet been given any indication of timing. When in Congress can we expect some action, Chairman?
I wish I could be here to give you perfect clarity on that, but neither am I completely empty-handed. So I do know that this is the subject of active interagency discussions at the moment, and I am hopeful that those will be fruitful.
And you know, Chairman, like a bird dog on point, that I would reiterate that the U.S. is the only G20 country to impose these initial margin requirements. And this has created what I fear is an unlevel playing field for United States institutions, and I believe it's time we come to focus. So my second very respectful question, last month the Basel Committee on Banking Supervision agreed to provide an offset for client-cleared initial margin under the leverage ratio. And the bipartisan CFTC commissioners support this offset, and I'm looking forward to the Fed and the other prudential regulators implementing this global revision. Can you give me a sense about timeline on that, perhaps?
I'll have to come back to you on that one. And
Fair
we'll do
enough,
so,
Mr. Chair.
so promptly.
You are following in those fine traditions dating back to Mr. Greenspan, and I respect that, and I say that respectfully. So once again, one final question, and I want to again voice my concern about the SACR proposal. I'm worried that higher capital charges under SACR will cause banks to pass those costs on to commercial end users engaged in OCT transactions, and Congress clearly sought to provide relief for end users as a part of Dodd-Frank. This proposal, I fear, threatens to undermine congressional intent and would deter end users from engaging in risk management activities. So I suspect you're aware of these concerns, and I hope that we will see them addressed. Just noting, from my perspective again, as a member of Congress from the 3rd District of Oklahoma, the food we produce, the energy we provide, those resources need these kind of risk management tools because of the sheer capital-intensive nature of the businesses. So focus, Mr. Chairman. I know you will. I appreciate you very much.
Thank you. That last one, I think you're probably aware, is out for comment after a lot of work.
Progress, Mr. Chair. I like that. Yield back, Madam Chair.
Thank you. The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for your endurance. We're almost at the end of the tunnel, it looks like. And I just wanted to focus a little bit on the widening income inequality gap that we've been talking about. And I wanted to follow up on your answers to Mr. Lawson and Ms. Axney. You've said that we've seen the gains of the past decade accruing to the upper income groups and passing the middle and lower income groups. Can you expand on the long-term systematic risks that such inequality would introduce in the economy of such skewing of benefits if it continues on the present course and into the future?
I think the tradition has been, or the history has been, that people have generally been able to progress and through time be economically better off than their predecessors, than their parents and grandparents and that kind of thing. And I think that's how people think about that have thought about life in our system. And I think the data show that that's less and less true. It's still true for many, but it's true for fewer than it used to be. And that's not good. I mean, we want prosperity to be spread as broadly as it possibly can, and we want there to be progress upward for lots of people, and we want mobility and from the bottom to the top, and vice versa. We want the outcomes to be fair. So, and if you don't have that, you ask what's the cost of it really? I think the costs are big, and that would include, kind of a loss of faith in our institutions to deliver that in our society. So I think it's a very important problem to address. And I also, by the way, I see lots of businesses and people coming around to that view that maybe weren't thinking that way 5 years ago. You hear that a lot. You hear a lot of discussion about this now in the business community. And they see it in terms of good employees and things like that, but also in terms of people to buy their products. So I think this is a national problem, and
So what happens to the bottom? I mean, it's not as simple as haves and have-nots. I mean, if it's shifting and the goal is always to move up, if you will.
Yeah.
What happens to the bottom? Do you all track and look at the poverty rates? Do you all look and track at the lower income levels?
Researchers
the people
do.
that are going is Representative Presley said, that are paycheck to paycheck?
We do, and lots of economists outside the Fed do track all of that.
Unless I miss it, I didn't see any data on poverty rates or what it's doing. I mean, your book talks about, the inflation rate of goal of 2%, the unemployment rate, as low as possible. But what is the bottom that we can reach in terms of a poverty rate?
I don't have a number for you. We have all that data. We don't put it in every monetary policy report. You probably saw the box, though, that talked about disparate labor market outcomes for people with a lot of education and people with less education, which kind of goes in that direction.
What do you find is unacceptable in terms of a poverty rate? Before it skews everything else, and
any positive number.
Any positive number?
Yeah, I think our goal should be to not have poverty. I mean, what's an acceptable number? There's in our country, there shouldn't no amount of poverty should be acceptable. It seems to me. Now I know we have a lot of poverty, but if you ask me that question, I would say.
Well, that would be my goal too, but for others it may not. I don't know if you follow, but the president wants to change the poverty line and how we index it to the CPI or the change CPI, and there's a proposed rule change. I mean, some people would rather just pretend that there is no poverty or that they've done something to reduce poverty, and changing the rules on how to calculate it doesn't get us anywhere. I just wondered if you have looked at that proposal and whether you favor it or disfavor it.
Have not looked at it. Wouldn't have an opinion on that.
You wouldn't? Well, I'm glad that you agree with me that the goal should be zero. That's something that I've worked with my entire life and will continue to do that. And I think that the minimum wage increase would be a step in that direction, and a number of other initiatives that I hope that we'll be able to get through Congress. So I appreciate your time. Thank you.
Thank you.
Thank you, Madam Chair. You're back.
Thank you. The gentleman from Minnesota, Mr. Phillips, is recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. When you get to me, you've reached the finish line. My first question, why is the U.S. dollar the world's reserve currency?
The U.S. dollar is the world's reserve currency. There tends to be one. So if you're the country with the best institutions, the largest economy, the rule of law, and relatively open to commerce, a trading nation, you can be that. Now, so what happens is there tends to be one reserve currency, and it tends to be a stable equilibrium for a period of time, but it's not infinite, right? The pound, of course, was the reserve currency for many, many years, but now the dollar has been for some time.
So what do you consider risks to that changing at some point in the future?
It's a very long-run thing. It's a fairly stable equilibrium. You have to think what currency out there would compete with the dollar, and there really, would be the euro, or it's hard to see the dollar not being the reserve currency for quite some time. That doesn't mean that there can be multiple reserve currencies, sure. And so there could be an equilibrium where there are two or three, and that would be fine. But right now, it really is the dollar, and I don't see that under threat right now. Of course, in the long run, it'll come down to fiscal sustainability. It'll come down to maintaining our rule of law and democratic institutions and prosperity and being a relatively open trading nation. All those things are essential.
In your opening remarks, you talked about concerns relative to our high and rising federal debt. Would that be a concern relative to the U.S. dollar maintaining?
In the long run, absolutely.
Okay. Second question, when you contemplate rate changes, how much weight do you give to the ongoing strength of current economic data versus the forward-looking weakness implied by the inverted yield curve?
I think it's monetary policy policy is always about the outlook. You have to understand and take into account the current position of the economy, which in our case is very strong, low unemployment, and stable relative price stability. But we're always about looking forward, because monetary policy works with a lag. You ask about the yield curve, and that's something we do look at, of course. Because there's a message in there. There are a couple of messages in there. You have to think carefully about what they might be, and it's not a single thing that is a dominant financial condition. There are many, many things that we look at in financial markets, and that's just one of them, but it's certainly one.
Okay. And lastly, do you believe that the Federal Reserve has the requisite tools to fulfill its mandate at the ZLB without assistance of fiscal policy?
Well, as I mentioned earlier, first of all, we do have the tools that we have, and we will use them aggressively, and we believe they will be adequate. As I mentioned, though, in a severe downturn, there comes a time when fiscal policy support is necessary and appropriate, and one of those times was during the global financial crisis and the Great Recession. So fiscal policy is very powerful, and I think is important to have. I think for the most part, the Fed can handle counter-cyclical policy, but in a steep downturn, there'll always be an important role for fiscal policy.
Okay. So is the authorization to buy a wider range of assets at the lower bound, would that be helpful or important, or not at this time?
I don't think we're seeking that. We're really not looking at that. We'll have plenty of treasuries to buy if it comes to that. If it comes to buying assets, there will be no shortage of U.S. Treasury securities, and I don't think we're looking at. Okay. You're referring to the fact that other central banks have the ability to buy equities and all kinds of different things. It's not an authority we are seeking or looking at or think that we need.
Okay. Thank you, Mr. Chairman, and I yield back.
Thank you very much. And so now we have the gentleman from California, Mr. Sherman. We're trying to honor your 1 o'clock time that we agreed upon, and we're just running a few minutes over, but we only have two. We have Mr. Sherman and we have Mr. Heck. So, Mr. Sherman, would you
I
take your
thank
5 minutes?
both the chairwoman and the chairman for their indulgence. It's been a couple of decades in this room. I've watched Republicans come here and condemn the Fed for overly loose money and condemn you for quantitative easing. I, for one, have been pushing in the other direction. It's interesting to see how with Trump's, I think one of our colleagues said, the Republicans seem to be in favor of loose money only when there's a Republican president. The fact is that you haven't hit your 2% inflation goal, and as we've talked earlier, it should be a 2.5% inflation goal, because we have, and while unemployment is low, we haven't had the big wage increases. You've told us that wages have grown, but basically by 1% over inflation, which doesn't make up for 30 years of negative or stagnant wage growth in this country for those without a college degree. On trade, I've seen the reverse roles in another way. Democrats voted against MFN for China, against NAFTA, CAFTA, and SHAFTA. But now that Trump is just flailing at the trade deficit, I hear an occasional Democrat saying we should just ignore the trade deficit. I don't think that flailing or ignoring is the right approach. I know that there's been significant discussion here about cryptocurrencies. This constitutes cryptocurrencies an attempt, I hope unsuccessful, to transfer power from the United States government to sanctions evaders, terrorists, tax evaders, and drug dealers, while reducing the importance, as the chairman indicated, of the United States dollar as the reserve and trade currency. Madam Chair, I know that we have an executive from Facebook coming to join us, but ultimately it is time to bring Mark Zuckerberg here. He is the one that has made billions of dollars out of us, relies on the U.S. government to protect his billions, and now wants to undermine the system. But I see his problem, and that is he wants to invade the privacy of the average American and sell our data. And in order to compensate for that, he wants to provide privacy to drug dealers and terrorists, thereby establishing how dedicated to privacy he is. So I look forward to bringing him here because the Libra is an attempt to create a cryptocurrency that you could actually use to buy things. Right now, we can kind of monitor the Bitcoin because to actually buy something, you need to convert it to the dollar. Mr. Chairman, I want to shift to another issue. We've talked last time you were here about wire fraud. Mr. Kustoff and I got 40 of our members to write you, and we just got the response today about the need for a name-matching system so that when you wire money not just to an account number, but to a name. Because especially in real estate transactions, we've had a lot of people tricked into wiring money into an account because hacking and spoofing has caused them to do that. The United Kingdom is moving to a safeguard system where when you wire the money, you wire it not just to an account number, but that you match it with a name. Your response indicated that there'd be some difficulty in doing that here. I know that we have state laws here that establish some rules, but you certainly have the capacity to regulate the financial institutions. You have regulations in this area. You could adopt regulations that say if you're going to accept a wire transfer, it has to be wired to a account name, not just to an account number. How do you plan on addressing this issue where people are conned into wiring money into an account number, thinking that's the owner of the property that they're trying to buy?
So we understand it's a serious issue and that it's something that they do in a very organized crime kind of a way, hacking into. They get a list of the real estate transactions. They try to hack into the players and they try to divert these payments. It's organized crime. You accurately, obviously, summarized the contents of that letter, and I would say, we have concerns about the matching name idea because we think it conflicts with some state laws. We think that really the way to get after it is to get banks to have appropriate ID from customers. But what I will propose, though, is let me get the people who are the experts in this to talk to you and your staff and try to...
And I would point out, this is clearly interstate commerce. This is clearly federal jurisdiction legal, and we've granted you the power. Please use it.
Great. Thank you.
Thank you very much. The gentleman from Washington, Mr. Heck, is now recognized for 5 minutes.
Thank you very much, Madam Chair. And Mr. Chair, thank you so much for staying back. I have a straightforward question. 5 days ago, the President of the United States said, we have a Fed that don't know what they're doing. So for the record, sir, do you?
I would say let's take a look at the economy and let that be the report card. So again, the economy is into its 11th year of expansion.
The longest in modern history.
Since we kept records, which began, I think, in the mid-19th century. Unemployment is at a 50-year low and has been for 15 months, and we expect that to continue. So, I think inflation is below where we'd like it. As you know, we're concerned about uncertainties and other factors that are weighing on the outlook and looking at changing our policy. But overall, I'd say that our economy is on a solid footing.
So, despite disagreements you and I may have had in the past about the actions I think the Fed should have taken with respect to interest rate raises, I want to state for the record, I do think that you know what you're doing. I thank you for being here. I thank you for your willingness and courage to stay independent. I thank you for your accessibility. You're only the third Fed chair that I've had the privilege to work with, but you're amazingly accessible. And I thank you especially for your remarks earlier in conversations with various members, notably Mr. Stivers and Mr. Perlmutter, regarding wage growth, and in particular, not being tempted to characterize recent wage growth as adequate, because it isn't adequate. And as you know, I've been asking since I came to this committee, when does America get a raise? And it's long overdue. but it sets up a bit of as it were, a dilemma for me. You have characterized here today that the cross currents confronting the American economy are trade and global growth. I want to know why it is, given that the Fed and you have accurately pointed to the fact that our economy is 70% consumer driven, why hasn't the Fed called out more than a generation of lack of wage growth a threat to this economy? If we want to have a healthy economy that is 70% consumer driven, we've got to have some decent wage growth, and we haven't. We have to have a prosperous, growing middle class, and we haven't. So why doesn't the Fed explicitly call out this lack of wage growth as a threat to the growth of this economy and the health of this economy?
Well, I think we do. I mean, I think we've been trying to promote.
You were asked, and you said the cross currents are trade and global growth. The other cross current, the other downward factor is the absence of wage growth. Is it not?
I think it's really, if you look at the last, go back to your point, go back to the turn of the century, what you saw was a decline in labor share. So, and that has not been reversed. So we're focusing on the change in wages, but really the level, they're missing, wages are missing 10 years of growth. So I think that's really the underlying problem. We're getting reasonable wage growth, but we missed all of those years beginning again at the beginning of this century. So I think it's a very serious problem, and we should do a better job of calling it out.
I look forward to you doing just that. Phillips curve. There was a recent article in the Wall Street Journal said that in Japan, the Phillips curve is dead. And obviously the connection, as was discussed here, alluded to here earlier, has become more tenuous even in this country. I would posit and ask for your reaction that the fact is that if you measure the Phillips curve in terms of U3, the connection's been more tenuous. But if you do, as you just now indicated, in terms of percentage of especially 25 to 64, 25 to 54-year-olds participating in the workforce, then the Phillips curve isn't dead, and that's in part why we're beginning to see some traction. Why would we continue to use U3 when it clearly isn't reflective of what has gone on, especially in the aftermath of the Great Recession, where people keep coming out of the woodwork to join this workforce, and as a consequence, that unemployment rate keeps going lower and lower, but we keep adding hundreds of thousands of people to the workforce. Is it not, have we repealed the law of supply and demand, or can we, if we continue to add people to the workforce, expect continued wage growth?
So U3 is just a number to us. It isn't the number. We refer to it quite a bit, but obviously we look at a broad range of employment indicators. I'm not sure I took your question though on this.
Well, I think my point is that we haven't reached full employment as long as people keep coming out of the woodwork.
Okay, that's where I thought you. Yeah. So I mean, that's what we're learning. We're learning this. A lot of the margin where we've seen the improvement has been in labor force participation rather than unemployment, and that's great. People come in, you could actually see, and you have seen in some months, you've seen labor force participation go enough labor force participation increase that the unemployment rate actually ticks up. That's a good thing.
So I'm way over, and the chair indulged me to even allow me to ask questions today again, for which I'm grateful. Two things: we need more wage growth. Secondly, I believe you know what you're doing, sir, and I thank you for it.
Thank you.
Thank you very much. Mr. Powell, we have one more member, the gentleman from Georgia, Mr. Loudermilk, and then we will wrap it up.
Thank you for your indulgence, Madam Chair. Chairman Powell, thank you. I will try to be quick and concise. I do have just a few questions, and so I won't make any statements. The first one, real-time payments. You and I have had this discussion before. Do you have any idea when you may announce the decision of whether to get into real-time payments or not?
We're in the middle of we haven't actually gotten to a place where we're getting ready to make a decision, but I think there's been a ton of work, and so we're moving forward to try to make a decision, when it's ready to do.
Okay. What are the factors you're weighing?
So this, as you know, this was something that came out of the Faster Payments Task Force. force, and that was a group of involved, small banks, large banks, community activists, technologists, card companies, all of that. And there was broad support, particularly among the smaller banks, as I mentioned earlier, for us to play a role in final settlement. And that was a recommendation that came out of that. So we put out a proposal last year, and we asked for comment. We got, I think, 400 comment letters, and we're piling through those and working our way through assessing the issues. We have to look at two things. One is just the requirements under the Monetary Control Act, and there's also just a big policy question, which is there a role here? There are people who feel strongly that there is a role here for us, and there are others who feel not. So we're having to make a decision on that, and we'll be doing that.
Okay, I appreciate if you keep us in the loop on that. We have several parties, especially in Georgia, very interested in the direction you're going. And so another issue regarding the tailoring of proposals, or the tailoring of regulation for domestic and foreign banks. Now that the comment period's closed, when do you expect final rules on that to be issued? On the tailoring of regulations for domestic and foreign banks.
Let me look for domestic and foreign. Okay, so the comment period for domestic, and I don't have a date for you. I know
I think the comment period is recently closed. I'm just wondering. From my understanding, the comment period recently closed on that. It's just
foreign it closed in June. For domestic, it closed in January.
Okay.
I have to come back to your office on. I don't know what I think Vice Chair Quarles said that we see most things being wrapped up by the end of the third quarter, and darn near everything wrapped up by the end of the year.
Do you anticipate the domestic and foreign will be done together?
I don't know.
Okay. With the remaining time, one other issue that's important, especially back in Georgia, small dollar lending. When the FDIC Chair McWilliams testified back in May, I asked her if they plan to address a small dollar lending issue for banks, and she said that she was going to work with the other regulators to get this done. Is the Fed committed to working with the FDIC and OCC to come up with a plan for the small dollar lending?
I think we're doing that, actually. I think there's an interagency group that's carrying that forward right now.
Okay. With that, I think we're all ready to end a very long morning. So I appreciate that. And Madam Chair, thank you for your indulgence, and I yield back.
Thank you very much. I'd like to thank Chairman Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the chairman for his response. I ask you to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned, and I thank you very much for your patience, Mr. Powell.